So let's begin. Let's begin our session. You know why we are all here. We're going to be discussing 30 questions from the entire syllabus. Now, these 30 questions, I have brought in a question each from each of the chapters. In addition to those questions from one chapter, I have also brought in some extra questions from some chapters, like, for example, from the meetings chapter, we have more than one question. From the Negotiable Instruments Act chapter, we have more than one question. Each of the special contracts, I've brought in one question at least. Prospectus and share capital, because they're big chapters, so I've brought in more than one question. And I've not randomly, picked any random question. I've not randomly picked questions. I've, carefully chosen questions on the basis of past trends. All right. So I think you will be able to handle your question paper in the examination at least a little better with these 30 questions. Of course, I am not going to tell you, I'm not going to make false claims that, study these 30 questions and go, and full question paper will get covered in these 30 questions. Of course, I'm not going to tell you that. Okay, but I will definitely tell you that these 30 questions will help you in some way or the other. Okay, and to make this session a little more effective than, what you are expecting it to be, what I'm planning is I'll be discussing these questions with you. And not only am I planning to discuss the questions with you, but also in that question, whatever concepts are involved, those concepts also I'll discuss with you. So I've brought in those concepts also in this file, and this file itself I will share on my Telegram channel once we are done with this session. Okay, so if you find anybody asking in the chat box about the material, you please handle that. Okay, tell them that they will get the material in the Telegram channel. Okay, so so first of all, don't worry about the material. The same material as it is, you will get it in the Telegram channel. Okay, and yes, it will be uploaded on my YouTube channel also. You will get it on my Telegram channel also. You'll get it everywhere. So you don't have to worry. Okay, now your entire focus has to be with me for the next 3 hours. All right, yes, 3 hours. I am hoping I'm able to get done in the coming 3 hours. All right, participate as much as possible in the chat box. That's what makes our session effective. All right, I am very excited to see how much this session is going to benefit you all. All right, so let's begin, guys. Without any further delay, let's begin. Let's start. Let's make these 3 hours the most productive 3 hours of today's session. And promise me, you will not take a break until I take a break. Okay, I'm the one who's going to be talking. So if I don't need a break, even you don't need a break. All right, you're going to stay with me for these 3 hours, continuous 3 hours. By now, we are used to sitting for long hours. Do you agree? Yes, so 3 hours is not a long time. You should be able to sit with me. That basic commitment, promise yourself that you will not give up in between. Dinner can wait, everything else can wait, everything else can happen once we are done with the session. Okay, so let's begin. Let's start off with the very first question. The first question in front of us over here, this is from the share capital chapter, and this question is all about the debentures concept. Before I read the question for you, it's a nice big question. It was a November 2022 6 marks question. Let me first of all quickly discuss the concept with you. The concept goes like this. This question is about the maximum issue of debentures. See, if a company is issuing debentures are in the form of a loan, right? So all the loans that the company has put together, it should not exceed 3 things: paid up share capital plus free reserves plus securities premium. Whatever loans the company is having, the loans that the company already has, whatever debentures the company already has, plus whatever debentures the company now wants to issue, everything put together should not exceed paid up share capital plus free reserves plus securities premium. 3 things. Come on, guys, repeat along with me once again. All these concepts, we don't have the time to look again. We will straight away look at these concepts before the exam only. So come on, register the things in your memory with me. Sit up straight, repeat along with me. Tell me the 3 things: the paid up share capital, free reserves, and securities premium. So debentures to be issued plus all the existing borrowings, whatever borrowings we already have, plus the debentures that we are going to raise later, everything put together should not exceed paid up share capital plus free reserves plus securities. Should not exceed paid up share capital plus free reserves plus securities premium. Okay. Now, what if I want to exceed the limit? If I want to exceed the limit, I can exceed. For that, I just have to pass one special resolution. If I pass a special resolution, I can exceed that limit also. But when I'm calculating this limit, in this limit, we will not include temporary loans. We will not include temporary loans. We will not include short-term loans and all. We will not include them. The limit is not even applicable to short-term loans and temporary loans. This is the first concept. What is the first concept? Total borrowings which the company already has, plus the debentures which the company wants to issue. Everything put together should not exceed paid up share capital plus free reserves plus securities premium. Point number 2, company, you want to exceed the limit? Okay, company, exceed the limit. If you want to exceed the limit, just pass one special resolution. You can exceed the limit. When you're calculating this limit, in this limit, what will you not include? You will not include temporary loans. You will not include short-term loans. Concept number 1, crystal clear. Now coming to concept number 2. Listen to me. Concept number 2. If the company wants to issue convertible debentures, if the company wants to issue convertible debentures or convertible loans or convertible preference shares for that matter, there is one precondition. When doesn't even matter what is the amount of the debentures, but if it is convertible debentures, then a prior special resolution is required. Concept number 1, concept number 2, two concepts involved in this question. Okay, and whatever maximum limit we have covered over here, this limit is as given in section 181C. Section number not very important. Just be aware of the concept paid up share capital plus free reserves plus securities premium. Keep this in your mind and now look at the question. Guys, look at the size of the question. Are you noticing the size of the question? Tell me, in the examination, if I'm going to read this question once, and if I'm going to reread the question the second time, and if I'm going to reread the question the third time, what's going to happen? Time waste. Can I afford that? No. We all know very well how important time is in those 3 hours, right? So the first time when you read the question, you will read it so well, you will read it with so much focus that your one reading itself should be sufficient. Because know that if you have to reread the question, that itself indicates what? That you're wasting time. So your first reading has to be your only reading. That is the only number of readings that we can afford. So with that same focus with me, you're going to practice only one reading. We should be done. Come on, you guys. Let's look at the question. The question says, Board of Directors of SRD Limited, an unlisted public company engaged in the business of manufacturing of two-wheelers, intends to issue debentures in order to finance its project of electric scooter manufacturing. The company seeks your advice regarding the maximum amount of debentures it can issue to raise the desired funds. So guys, what is this question about? What are they asking us? Company seeks your advice regarding maximum amount of debentures it can issue to raise the desired funds. Now let us look at the rest of the question. Company has provided the following abstracts from its financial statements ended on 31st March 2022. They have given us information about authorized share capital, which is irrelevant for us. Then they've told us about subscribed and paid up share capital, 40,000 equity shares of 100 rupees each, 40 lakh, share premium, general reserve, P&L, capital reserve, 8% non-convertible debentures, 9.5% term loan from XYZ Bank Limited for purchasing plant and machinery. Repayment starts after 1 year moratorium period. Guys, have you come across this word anywhere in your syllabus? Tell me that. Nowhere. Nowhere you would have come across this particular point. Have I given you this? Because an average student will look at this in the examination and here itself that student will give up that, oh, I don't know this question. And that is what the whole objective is. Always remember, in your law paper especially, they will try to play some vocabulary games with you, wherein in 1 or 2 questions, they will give you some super fancy terminology, which will make you start doubting your own knowledge. Okay? I'll tell you something at this point, which you should remember during your examination. When you walk into the examination hall, you walk in with confidence that you have done enough preparation. When you walk into the examination hall, you walk in with a confidence that you know it all. Which means if you find something in your question paper which you've never even heard of before, It doesn't mean you did not learn it. What it means is it is not even relevant. So if in this question, if you're going to ignore this, okay, nothing is going to happen. This point over here is only given to intimidate you. This point is given over here just to scare you. You're understanding? So you do not have to worry. Words like these, if you find in the examination, you just ignore these words and you keep reading the paper. Trust me, these kind of words will have absolutely no impact on your answer. Okay, so never get swayed away by big words used in the examination. Trust me when I say this. I have been noticing examinations have been purely, I've been actually nicely registering and making a note and doing proper research on the way in which they're making question papers. All these 8-9 years I've been looking, and this is one thing which I have found in every law exam, in every paper. In every attempt, every law paper, you will find some super fancy language somewhere or the other. But if you ignore it, you will still be able to answer it. So have confidence in your preparation. It is not something which you don't know. It is something which you are not required to know. But just for the sake of your knowledge, what do you mean by moratorium period? During the COVID times, okay, when people were under, our country was under lockdown. Lockdown means no business is running. If business is not running, do I have money in my hands for day-to-day business? No. Do I have money in my hands to repay bank loan? Do I have money in my hand to repay bank EMI? No money in my hands. So therefore, the banks gave moratorium period, which means the bank said that, listen people, listen borrowers, for this 1 year or whatever period they had mentioned, for this 1 year, you don't have to repay principal amount to me. You don't have to repay the EMI amount to me. Interest will obviously keep accruing, but you don't have to repay the EMIs to me. You can start repaying the EMIs after this particular period. So there was one period where the borrowers did not have to repay EMIs. Interest was obviously accruing, but that obligation to pay EMI was not there. Okay, that is this period. Then coming to the next point, short-term, guys, short-term cash credit loan from XYZ Bank Limited on hypothecation of stock and receivables of the company, repayable on demand 50 lakhs. Referring to and analyzing the relevant provisions of the Companies Act, advise the company presenting the necessary calculations, amount that can be raised by the company by issuing debentures, and the resolution, if any, is required to be passed in the general meeting of the company in respect of the same. Let us focus on the first question. The first question is asking us, what is the amount that can be raised by the company by issuing debentures? How much amount we can issue debentures? See, listen, how will we do this calculation? We'll do this calculation over here. I'll get some space. Listen, what is the maximum limit I told you? What is the maximum limit, please? How many things will you look at? 3 things: paid up share capital, free reserves, and securities premium. Now, paid up share capital, should I take this 40 lakh number or should I take the authorized capital number? Not the authorized capital number, I'll take this 40 lakh number. So paid up share capital, 40 lakhs. Free reserves, tell me, is share premium free reserve? No. Is general reserve free reserves? Can I take the general reserve number? Yes, I can take the general reserves number. General reserve number is how much? General reserve number is 30 lakhs. Then can I take balance in P&L? Yes, even this is going to be free reserve, right? So this is how much? This is 20 lakhs. Then securities, can I take capital reserve, by the way? Is capital reserve also free reserve? No, I can't take this. So, and what else? What's the third element? Securities premium. Do I have any securities premium money? Yes, I do have. I have 50 lakhs. So what is my total maximum limit? 40 plus 30 plus 20 plus 50. My maximum limit is 140 lakhs. So this much borrowings I can have totally. How much borrowings do I already have? What are my existing borrowings? How much borrowings do I already have? Is 8% non-convertible debentures borrowing? Can I call this 30 lakhs as borrowings that I already have? Yes, 30 lakhs non-convertible debentures. Debentures also are in the form of loan only. So yes, this is existing borrowing. Then 9.5% term loan, 20 lakhs. Even this is existing borrowing, guys. Existing borrowing. Short-term cash credit loan, should I consider this also? Should I consider the short-term loan? I will not. Why will I not consider? Because if you remember, I told you in the concept part that temporary loans, short-term loans, ignore. So I will not consider the short-term loans. So therefore, how much loan do I already have? I already have 50 lakhs of loan. So tell me, if the company wants to raise debentures now, for how much amount company can maximum issue debentures now? Maximum issue of debentures can be for how much now? Total 140 lakh borrowings allowed. We already have 50 lakhs borrowing. We can now raise more debentures for 90 lakh rupees. Okay, now tell me, what if I want to raise debentures for more than 90 lakhs? Company is asking, is there any possibility? Will you please let me issue debentures for more than 90 lakh rupees? What will you say? Fine, okay. Pass a special resolution of your shareholders. What do you mean by special resolution? Will you write 3/4 number? No. Will you write 75% number? No. What will you write? What is special resolution? Special resolution is a resolution where the number of votes in favor is, tell me the sign, 3 times the number of votes against. Tell me the sign, please. What is the sign that I should put over here? Number of votes in favor. Should I put the sign more than? Should I put the sign more than or equal to? I should put the sign more than or equal to. So what is special resolution? You will not write the 75% number anywhere. You will not write the 3/4 number anywhere. You will explain it using the terminology given in the law. What is the terminology given in the law? The number of votes in favor is at least 3 times the number of votes against. Number of votes in favor is at least 3 times the number of votes against. And by the way, ordinary resolution, how will you explain? Ordinary resolution, you will say that the number of votes in favor is more than the number of votes against. Right? Ordinary resolution, number of votes in favor is more than the number of votes against. So that is it about the first question, guys. So the first question is asking us how much debentures we can raise. We said 90 lakhs. And we also said that company, if you want to raise for more than 90 lakhs, don't worry. You pass one prior special resolution, then you can raise. That is it about my first question. Now come to the second question. Second question, as soon as we read the question, your answer should be ready. What will be your answer in case the above company desired to issue debentures with an option to convert such debentures into shares? If the company wants to issue convertible debentures, tell me, does the amount matter to you there? If the company wants to issue convertible debentures, doesn't even matter what is the amount, whether more than 90 lakhs, whether less than 90 lakhs, company convertible debentures means you anyways need to pass a special resolution. Irrespective of the amount, company will have to pass a special resolution. That is it with my first question. Are we all crystal clear? Yes, so through my first question, what is my summary now? What is my summary? My first point is that the total borrowings, existing borrowings which we already have, existing borrowings plus the debentures that the company wants to issue, debentures to be issued, everything put together should be within paid up share capital plus free reserves plus securities premium. Company, if you want to exceed the limit, you can exceed the limit by passing one prior special resolution. Learning number two, company, listen, if you want to issue convertible debentures, if you want to issue convertible loans, if you want to issue convertible preference shares, it doesn't even matter what the amount is, irrelevant of the amount, irrespective of what the amount is, you anyways have to pass a special resolution. Can I close the first question? Done and dusted. You will be able to handle it in the examination. Yes, guys? Come on, let's proceed. Let's go to the second question. The second question is from your chapter Accounts of Companies. So the first question we did from the share capital and the debentures chapter. The second question over here is from your Accounts of Companies chapter, CSR discussion. 99% you will get at least one question from CSR in your examination, either in the MCQ part or in the descriptive part. Be prepared. From the Accounts of Companies chapter, you will definitely be having at least one question from CSR. That is how important CSR is for your upcoming examination. That is why purposely I have picked a question from CSR, and this is that one question through this one question itself, multiple concepts under CSR will get covered for you. Okay, listen, before we look at the question, shall we quickly revise the concept first? Just like how we did in the first question, this is how we will be doing all the questions. That way, your revision also will keep happening side by side. Those 3 hours are going to get very nicely utilized. Okay, listen to me. Let us have a look at the concept. See, if the company fulfills even 1 out of 3 conditions, condition 1, condition 2, condition 3. In between, I will put the word or. So I have 3 conditions. Okay, out of 3 conditions, even 1 condition, if the company fulfills, it can be any company. It can also be a Section 8 company. Any company out of 3 conditions, even 1 condition, if you fulfill, CSR will apply for you. What are the 3 conditions? Condition number 1, net worth should be at least 500 crores. Condition number 2, turnover should be at least 1000 crores. Condition number 3, net profit should be at least 5 crores. So net worth at least 500 crores, turnover at least 1000 crores, net profit at least 5 crores when in the preceding financial year. When in the preceding financial year. Come on, everybody, tell me the 3 numbers. Net worth at least 500 crores, or turnover at least 1000 crores, or net profit at least 5 crores. When in the preceding financial year. Without seeing, one last time. Net worth at least 500 crores, or turnover at least 1000 crores, or net profit at least 5 crores. When in the preceding financial year. Which company? Any company, every company, even Section 8 company, any company which fulfills even 1 out of these 3 conditions, for all those companies, CSR is applicable. Now, when I say net worth, what do you mean by net worth? How do you calculate net worth? Paid up share capital plus free reserves plus securities premium minus accumulated losses minus deferred expenses minus miscellaneous expenses. The net number that you get, that will be called as net worth. Tell me the 6 things. Paid up share capital plus free reserves plus securities premium minus accumulated losses minus deferred expenses minus miscellaneous expenses not written off. The net number that you get, that becomes your net worth. And net worth should be at least how much? Net worth should be at least 500 crores, or turnover should be at least 1000 crores, or net profit should be at least 5 crores when in the preceding financial year. Okay, now listen, will I consider revaluation reserve also when I calculate net worth? No, net worth is only paid up share capital plus free reserves plus securities premium minus accumulated losses minus deferred expenses minus miscellaneous expenses not written off. I am not going to consider revaluation reserve and all. Now, then second number, when we talk about net profit number should always be net profit before tax. Remember, for the whole of the CSR discussion, wherever you talk about net profit, for the whole of the CSR discussion, you're only talking about net profit before tax. Net profit before tax, before set off of past losses, before capital payments or receipt. Before tax, before set off of past losses, before capital payments and receipt. One last time, before tax, before set off of past losses, before capital payments and receipts. And also, from this net profit, you will exclude 2 things. You will see what is a net profit. In the net profit, you will exclude 2 things. If the company has any overseas branch, which means if the company has a foreign branch and that foreign branch has earned any profit, that foreign branch profit you will exclude. Then, has the company received dividend income, not paid dividend? Has the company received dividend income from any other Indian company which is properly complying with CSR provisions? So you will see what is the total net profit of the company. From this net profit, you will exclude the net profit of the foreign branches. From this net profit, you will exclude dividend income which we have received from those Indian companies which have properly complied with CSR. Only the balance net profit number we will take. So net profit before tax, before set off of losses, before capital payments and receipts we will take. Okay, now listen, if these conditions are fulfilled, out of these 3 conditions, if even 1 condition is fulfilled, then the company will have to follow CSR. But when the company is following CSR, how much money does a company have to spend on CSR? What is the minimum amount which the company has to spend on CSR? The company will have to see 3 preceding financial years. In these 3 preceding financial years, how much net profit has the company earned? We have to see. So 3 preceding financial years, 3 numbers we will have, 3 profit numbers we will have. We will find the simple average of those 3 numbers. 2% of that simple average, that is a minimum amount which the company has to spend. So minimum company has to spend 2% of the average net profit of the 3 preceding financial years. But however, what if this is the second financial year? What if this is the third financial year. What if we don't have 3 preceding financial years? If you don't have 3 preceding financial years, how many ever financial years you have, that many years average you take. Like for example, right now we are in year 3. So how many preceding financial years we have? We have only 2 preceding financial years. So in that case, you will take average of these 2 you will take. Simple as that, guys. Understood all these points, everybody? Yes, so come on. One last time, guys. What are the CSR provisions? Tell me the 3 conditions. Every company whose net worth is at least 500 crores or turnover is at least 1000 crores or net profit is at least 5 crores. When in the preceding financial year, which company? Any company. Section 8 company also. Yeah, any company. So any company, net worth at least 500 crores, turnover at least 1000 crores, net profit at least 5 crores. Any one condition also fulfilled in the preceding financial year, welcome to CSR. Now, what does CSR provision say? Last 3 years, we will see how much net profit you have. We will find the simple average of those net profit, 2% of that simple average. That's the minimum amount you have to spend on CSR in the current year. Now, here when I say net profit, is this also net profit before tax? Yes, in the whole CSR discussion, wherever you see net profit is before tax, before set-off of losses, before capital payments and receipt. Also, in that net profit number, you should exclude profit from overseas branches. You should exclude dividend income from those Indian companies which have properly complied with CSR. Exclude all that net profit number. Exclude all those incomes. Take only the balanced net profit number. So, what is my rule about net profit number? Net profit number should be before tax, it should be before set off of losses, it should be before capital payments and receipts. Okay, also from this net profit number, we should remove whatever profit we have earned from foreign branches. We should also remove whatever dividend income we have received from those Indian companies which have properly complied with CSR regulations. With all of these concepts in our mind, shall we look at this question now? Yes, guys, how many questions can we afford? How many readings can we afford? Only one single reading we can afford. So come on, sit up straight and listen with 100% focus. Read along with me. Skip Limited, the company, was incorporated on 1st April 2019, which means financial year 1920 is the first financial year of the company. Okay. Balances extracted from its audited financial statements are given below. Financial year 1920, financial year 2021, for 2 years, they have given me information. They have given me 2 numbers, net profit before tax, net profit after tax. Ignore tax computation, they're telling me. But I know anyways, net profit after tax is not even relevant for me. Only net profit before tax is relevant for me. Then the question is telling me, company proposes to allocate minimum required amount for CSR activities. So company does not want to spend too much. Company wants to allocate only minimum amount for CSR activities during financial year 21-22. So the current financial year is 21-22, which means how many preceding financial years do I have? I have only 2 preceding financial years. I have current year is my 3rd year. So the company proposes to allocate minimum required amount. So only minimum amount company wants to spend on CSR, that too only if it is mandatory. Okay. You are requested to advise the company in this regard. Compute the minimum amount to be allocated if so required, taking into account the relevant provisions of the Companies Act 2013. So they're asking us, first of all, is CSR mandatory for this company? If mandatory, how much minimum amount has to be spent? Now tell me, how will I know whether for the company CSR is applicable or not? I have 3 things to check. I will look at preceding financial year 3 numbers, net worth number, turnover number, net profit number. Do I have net worth number? No. Do I have turnover number? No. Do I have net profit number? Yes, 4 net profit numbers I have. Out of the 4 net profit numbers, tell me only 1 net profit number is relevant. Which net profit number is relevant? Obviously, guys, preceding financial year. My current financial year is 21-22. So what is my preceding financial year? 2021. 2021 only net profit before tax only we consider, which is 7 crores. This 7 crores number is at least how many crores? It is at least 5 crores. So net worth at least 500 crores or turnover at least 1000 crore or net profit at least 7 crore. Any one condition fulfilled, guys? Yes, one condition fulfilled, which means do you agree that CSR is going to be applicable for the company? If CSR is applicable for the company, tell me what is the minimum amount which the company has to spend? We first of all have to see 3 preceding financial years, how much net profit the company has made. So, but then, do we have 3 preceding financial years? No, this is only the 3rd year. How many preceding financial years do I have? I have only 2 preceding financial years. So, these 2 preceding financial years, how much net profit number do we have? We have 5 crores and 7 crores. Divided by 2 or divided by 3? I have only 2 preceding financial years. So 2 years average I will find. So what is the average net profit of the 2 preceding financial years? 12 crores divided by 2, you will get 6 crores, guys. This is the average of the 2 preceding financial years net profit. So what's the minimum amount to be spent? 6 crores into 2%, which is going to be 12 lakh rupees. So this is how much money the company has to minimum spend on CSR, as simple as that. Okay, so after this question, any CSR computation question, you should not get scared in the examination. Okay, I've noticed in the generally what happens is, if students see a balance sheet given in the law paper, if students see some numbers given in the law paper, there itself gone. There itself they lose their confidence. No, guys. If you noticed, even the first question, purposely I brought a computation question from debentures. Even the second question over here, purposely I brought a computation question from CSR. Just discussing, 500 crores, 1000 crores, 5 crores. Just discussing the numbers I've seen is not giving confidence to the students. But now that we have worked it out once, now I think you will be able to handle any CSR question based on limits. Any CSR question you get which is based on limits, I'm hoping now you will be able to handle. How are you going to do it? What's the first thing that you will do? You will first check, is a net worth at least 500 crores, or is a turnover at least 1000 crores, or is a net profit at least 5 crore. Out of 3, even one condition is fulfilled, you will conclude, okay, CSR is applicable. And all these numbers you will see in the preceding financial year. If CSR is applicable, how much minimum has to be spent on CSR? You will see 3 preceding financial years, how much net profit have we made? Find average of that, 2% of that average, that's the minimum amount that we have to spend. Okay, that's it about this question. All right, guys, that was question number 2 for you. So question number 2, and by the way, remember, for the whole of CSR discussion, I'm considering only the net profit before tax, before set off of losses, before capital payments and receipts. And also, what are the 2 numbers which I will exclude from net profit? Whatever profit we have earned from foreign branches, and one more thing, whatever dividend income we have received from those Indian companies which have properly complied with CSR, all those numbers I will exclude. And also, please remember that one last thing, net worth, how do we calculate? Paid up share capital plus free reserves plus securities premium minus accumulated losses minus deferred expenses and minus miscellaneous expenses not written off. Okay, guys, that is it with question number 2. So question number 1 was from share capital. Question number 2 was from CSR accounts of companies. Now, let us come into other laws. Okay, we'll come back to company law in some time. Let us come to the other laws. Let us have a look at the third question. The third question over here is from the guarantee special contract. Okay, only one reading we can afford. Listen carefully. Before we read the question, let me quickly give you a summary of the concept. In guarantee contract, can we have a minor as a party to a guarantee contract? Yes, a minor can be a party. But can the minor be creditor? No. Can the minor be surety? No. The minor can only be principal debtor. We all know very well that in any guarantee contract, there are how many parties, guys? In any guarantee contract, for that matter, there are 3 parties. We have the principal debtor, we have the creditor, and we have the surety. We have 3 parties, and between these 3 parties, we have 3 contracts. We have the principal contract between the creditor and the principal debtor. We have the guarantee contract between the secondary contract, the guarantee contract between the creditor and the surety, and then we have an implied indemnity contract between the surety and the principal debtor. Right? Out of these 3 parties, only one party can be a minor. And who is that one party who can be a minor? The principal debtor. He is the only party who can be a minor. Even if the principal debtor is a minor, it's okay. The guarantee contract will not be affected. Guarantee contract will still be valid. Capacity of principal debtor does not affect the validity of the guarantee contract. Clear till here, first of all? So in a guarantee contract, there are 3 parties. Out of these 3 parties, only one party can be a minor. Which party can be a minor? Only the principal debtor can be a minor. Concept number 1. Now coming to concept number 2, then the concept number 2 is about the surety's liability. Under surety's liability, this is going to be my discussion now. See, the surety's liability is coextensive with the principal debtor's liability, which means what? Which means that the surety will be liable only for how much ever amount the principal debtor is liable. For whatever amount the principal debtor is liable, only for that amount surety will be liable. Which means if the principal debtor is not liable, even surety not liable. If principal debtor is liable for 10 lakhs, surety also liable for 10 lakhs. So surety's liability is coextensive with the principal debtor's liability, which means the surety will be liable only for whatever amount the principal debtor is liable. If principal debtor is discharged, even the surety will get discharged. Then this is not relevant for our question, but still let us discuss, guys. It will be a good revision for us. The second point says that the surety's liability is secondary, which means whose liability is primary? Who has to first of all make the repayment? The first of all repayment has to be made by the principal debtor. Only if the principal debtor defaults, only then the surety will perform. So surety's liability is only secondary. First liability is liability of the principal debtor. And then talking about the last point over here, the third point over here, in case the principal debtor defaults, in case the principal debtor is not repaying the loan, can the creditor directly sue the surety without even suing the principal debtor? Can the creditor directly sue the surety? Yes, the surety can be proceeded against even without proceeding against the principal debtor first. We can directly sue the surety even without suing the principal debtor first. We can directly sue the surety. 100% clarity about the concept, guys? Yes. So listen, what are the 2 points? Only 2 points we've discussed. Point number 1, in guarantee contract, which party can be minor? Principal debtor can be minor. And concept number 2, tell me about the surety's liability. 3 points. Point number 1, surety's liability is coextensive with the principal debtor's liability. Point number 2, the surety's liability is only secondary. Principal debtor's liability is primary. Only if principal debtor defaults, only then the surety will perform. And the third point, in case the principal debtor defaults without even suing the principal debtor, the surety can, the creditor can directly sue the surety. The creditor can directly proceed against the surety even without suing the principal debtor first. With all this knowledge, look at this question now. Come on, you guys. Paul, a minor. Paul, a minor. Paul, a minor. He purchased a smartphone on credit from a mobile dealer on the surety given by Mr. Jack, a major. When you finish reading till here, does your mind immediately tell you guarantee contract? If guarantee contract, can we please identify the parties? What will Paul become? Paul purchased. So Paul will become the principal debtor. On credit from the mobile dealer. Mobile dealer is a seller. So mobile dealer will become the creditor. On the surety given by Mr. Jack. So Mr. Jack is a surety. Paul did not pay for the mobile. By the way, Paul, principal debtor, is a minor. Is it okay? Yes, principal debtor can be a minor. This guarantee contract will still be valid. Paul did not pay for the mobile. Mobile dealer demanded payment from Jack because the contract entered with Paul is void. Mr. Jack argued that he is not liable to pay the amount since Paul, principal debtor, is not liable. Whether the argument is correct under the Indian Contract Act 1872, tell me till here first, then we will go to the second part. You understood the question? We have 3 people in the story. We have the creditor, we have the principal debtor, and we have the surety. Santosh, you can do drawings later, Santosh. Listen. See, creditor, principal debtor, surety, 3 people we have. Creditor is the mobile dealer. Principal debtor over here is Paul, and Paul is the minor. Surety is Mr. Jack. What happened over here is this principal debtor, Paul, he has defaulted. Because he has defaulted, the creditor is coming to the surety and demanding money. Surety is saying that principal debtor is minor. So minor is not liable. If minor is not liable, even I am not liable because my liability is coextensive with principal debtor's liability. What will we say? Whatever surety is saying, is he right? What will our answer be? Our answer is no. See, generally the surety's liability is coextensive with the principal debtor's liability. Generally, yes, generally the surety's liability is coextensive with the principal debtor's liability. However, if the principal debtor is minor, principal debtor will not be liable, but surety will still continue to be liable. So listen, Mr. Jack, yes, generally your liability is coextensive with Paul's liability. However, if the principal debtor is a minor, he is not going to be liable. Even though he is not liable, surety, you will still be liable. The guarantee contract will remain valid and you will still be liable. So you cannot take the excuse that you are not liable. Then the question is asking us, what will be your answer if Jack and Paul both are minors? What will you say? What is Jack and Paul? What if even Jack is a minor? Can surety be a minor? See, surety and all cannot be a minor. Who is the only party who can be a minor, guys? Only the principal debtor can be a minor. If the surety is a minor, if Jack is a minor, then what will happen to the guarantee contract? The guarantee contract itself gone void. It will become void. Understood. So generally, the surety's liability is coextensive with the liability of the principal debtor. Generally, however, there are some exceptional cases. In those exceptional cases, what do we say? In those exceptional cases, even though the principal debtor is a minor, even though the principal debtor is not liable, surety, you will still be liable and the guarantee contract will still be valid. Understanding, everybody? Come on, read this along with me. If the creditor or the surety is incompetent to contract, then guarantee will be void. Creditor and surety, they can't be incompetent. But if only the principal debtor is incompetent, the guarantee contract will remain valid. Capability of the principal debtor does not affect the validity of the guarantee contract. Are you able to recall all this, guys? Do you recall learning all this? Is that refresh button in your memory getting pressed again and again? Yes, all these concepts, even if you don't revise the day before the examination, you should still be able to handle. All right, guys. So this was our discussion from the guarantee special contract. Can I take you forward? Can I take you to the next question? So through this question, we have learned that surety's liability is coextensive with the principal debtor's liability, which means the surety will be liable only for whatever amount the principal debtor is liable. However, if the principal debtor is minor, the principal debtor will not have any liability, but the surety will still be liable. The guarantee contract will still be valid. That was a summary for you. Now coming to question number 4. Question number 4 is again a question from same guarantee only. Before I discuss the fourth question with you, let me tell you the concept that is involved over here. Listen to me carefully. See, if the creditor does some act or if the creditor does some omission, both the words you will write in the examination, if the creditor does some act or omission because of which the principal debtor is discharged. Creditor has done some act or omission because of which the principal debtor is discharged, then automatically what will happen to the surety? Even the surety will get discharged. Which concept are we indirectly applying over here? Two concepts we are applying. See, you remember learning about discharge of surety? One big concept you would have learned about discharge of surety. Under discharge of surety, 3 buckets you must have learned. Discharge of surety by revocation, discharge of surety by conduct of creditor. Under discharge of surety by conduct of creditor, you must have learned any variation in the terms of the principal contract without the permission of the surety. First point. Second point, you must have learned this only, release or discharge of the principal debtor. So this concept over here is from discharge of surety. Concept number 1. And what is one more concept indirectly involved over here? If principal debtor is discharged, automatically surety is discharged. Which concept is indirectly involved over here? Don't you think the coextensive concept is indirectly involved over here? 2 concepts are involved here. Understanding? Crystal clear? Yes, so if the creditor does some act or omission because of which the principal debtor is discharged, then in that case, the surety also will automatically get discharged. Okay, with this in your mind, now have a look at this question. This question is an ICI practice manual old syllabus question. There are some questions in the old syllabus practice manual which till now they have not asked in our examination. Only a few questions are left like that. This is one of those questions. Don't be surprised if the same question copy paste if you find in your upcoming examination, highly probable. Listen, a farmer contracted to sell grains to the merchant to be grown on his land. Farmer contracted to sell grains to a merchant to be grown on his land. S guarantees performance by the farmer. By now, have you identified that this is a guarantee contract question? Can you please also help me identify who the parties are? Farmer is going to sell grains to a merchant to be grown on his land. S guarantees performance by farmer. So first of all, S is surety, no doubt about that. S is guaranteeing performance by farmer. So what will you call the farmer here? Farmer becomes a principal debtor. So merchant becomes a creditor. Okay, so we have three people. We have the surety, we have the farmer who is the principal debtor, we have the merchant who is the creditor. So the farmer, whatever grains he's going to grow in his farm, he's going to give those grains to the merchant, and for this the person Mr. S has given guarantee. Now listen, merchant later diverts the stream of water necessary for irrigation of farmer's land. As a result, the crop could not be grown. Is S liable for the guarantee? Read the sentence once again. This is the most important sentence in this question. Merchant later diverts the stream of water necessary for the irrigation of farmer's land. As a result, the crop could not be grown. So we have the farmer's land here, okay, let us say, and there is a stream of water that comes into the farmer's land to irrigate the farmer's land. What the merchant does is, the merchant blocks this stream of water. So the merchant over here has done one act. What is the act which the merchant has done? He is blocking the stream of water. So if the water doesn't flow into the farm, will the farmer be able to irrigate his land? The farmer will not be able to irrigate his land. If the farmer is unable to irrigate his land, will the farmer be able to grow crop on his land? He will not be able to grow crop. If he is not able to grow crop, will he be able to give the crop to the merchant? He will not be able to give the crop to the merchant. So over here, the merchant has done one act. Because of the merchant's act, the principal debtor, the farmer is not going to be able to perform his obligation. So the farmer is not going to be able to perform his obligation because of the merchant's act itself. So if the merchant does an act because of which the principal debtor can't perform his obligation, the principal debtor is going to get discharged, guys. See, obviously, without water, how is he going to grow his crop on his land? Without the crop, how is he going to fulfill his obligation towards the merchant? So the farmer is not going to be able to fulfill his obligation, all because of whom? All because of the merchant's act himself. So if the merchant is himself preventing the farmer from fulfilling his obligation, farmer discharged. If farmer discharged, what will happen to the surety, guys? Even the surety will get discharged. So over here, the merchant has done an act which discharges the farmer, because of which, as a consequence, even the surety will get discharged. So this question is about the creditor's act. The creditor has done an act because of which the principal debtor is discharged. Hence, automatically even the surety will get discharged. Now, do you remember the example relating to omission? There is one standard example relating to omission. Do you recall? Let me give you a revision if you don't recall. Do you remember learning this? There was one, let us say, a carpenter or a construction contractor, whatever, and there was this person, Mr. A, let us say, and there was his surety. So this construction contractor, he promised Mr. A that he will complete the construction of the house in 1 year. And the surety gave guarantee to Mr. A that Mr. A, don't worry, if the construction contractor is saying 1 year, means within 1 year he will complete the construction. Mr. A is telling the construction contractor, wait, to do the construction of this house, whatever wood you require, I will only supply this wood to you. So with that wood only you construct the house. Construction contractor told Mr. A, if you want me to complete the house by 31st December, if you want me to complete the house, then you supply the wood to me by 31st March, you supply the wood to me. Only then I will be able to complete the construction by 31st December. Mr. A said, okay. For this whole thing, surety gave guarantee to Mr. A that don't worry, construction contractor will complete by 31st December. Now, if Mr. A himself does not supply the wood by 31st March, tell me, will the construction contractor be able to fulfill his obligation of completing the construction by 31st December? No. If Mr. A himself is not supplying the wood, then the construction contractor will not be able to perform his obligation. Why is construction contractor not able to perform his obligation? Because of Mr. A's omission. Don't you think this is omission here? Why omission? Because Mr. A is not doing something that he is supposed to do. Right? Mr. A is supposed to supply the timber. He is not doing what he is supposed to do. So if you don't do what you are supposed to do, it becomes an omission. So Mr. A has done an omission, because of which the construction contractor gets discharged. So automatically even the surety is going to get discharged. So this is your example for omission, and this question was an example for act. Right? The principal debtor has done an act, the creditor has done an act, because of which the principal debtor is discharged. So automatically even the surety will get discharged. Can we close this question also? Can I take you to the next question, guys? Yes, so we have seen two questions from guarantee. Now look at this question number 5. This is from bailment, guys. This question is from bailment. Okay. Before we read this question, shall we quickly have a look at, let's have a look at the concept first. Do you remember learning about the bailie's duties? Bailie's duties. One of bailie's duties is that he is not supposed to mix the bailed goods. If he wants to mix the bailed goods, he can mix with the bailor's consent. If he is mixing with the bailor's consent, then whatever is the final output, that final output, both the parties, bailor and the bailee, they will share. So if the bailee mixes the bailed goods with his own goods, with the consent of the bailor, if he is mixing, then whatever is the final mixture, in that final mixture, both the parties will take their respective shares. But what if they mix without the bailor's consent? If they mix without the bailor's consent, then we will check that are the goods separable or are they not separable. If they are separable, if separation is possible, then in that case, bailee will have to separate the bailed goods from his own goods, and who will bear the separation expense? Bailee only will have to bear separation expense. But what if they are not separable? If they are not separable, you will treat as if whole goods itself lost. So entire value of the goods lost will be borne by the bailee. So listen, bailee, you are not supposed to mix the bailed goods with your own goods. Come on, listen. Final time, final revision. Sit up straight. Listen, guys. Bailee, you are not supposed to mix the bailed goods with your own goods. You want to mix, you go get the bailor's consent. If you get the bailor's consent and then if you mix the goods, in the final output, both of you can share. Like for example, I had 100 bags of rice. I gave it to the warehouse keeper to keep safely. He also had 50 bags of rice. He mixed them all together with my consent. So total 150 bags now. Later in this mixture of 150 bags later, I will take 100 bags and he will keep 50 bags. So if I mix with the consent of the bailor, then in that case, in the final mixture, bailor, bailee, both will share proportionately. But what if the bailee mixes without my consent? We will see, are they separable or are they not separable? If they are separable, my 100 bags separable, his 50 bags separable. If they are separable, then in that case, the bailee will have to take the effort and separate my goods from his own goods. The bailee will have to separate the bailed goods from his own goods, and who will bear the separation expense? Bailee himself will bear the separation expense. What if they are not separable? If they are not separable, like for example, he mixes my 10 liters of oil with his 50 liters of oil. Now, is it possible to separate the oil drop by drop? Of course, it is not possible. If they are not separable, if the goods are not separable, you will treat as if my entire oil which I had given to him, entire oil is lost. You will treat as if the entire value of goods is lost. And who will bear the value of this loss, guys? The bailee only will have to bear the value. This is a concept involved over here. Keeping this concept in your mind, let us have a look at this question, guys. Look at this. Amar bailed 50 kg of high quality sugar to Srijit. So who is the bailor? Amar becomes the bailor. He bailed 50 kg of high quality sugar to Srijit. Srijit becomes the bailee, okay, who owned the kirana shop, promising to give 200 rupees at the time of taking back the bailed goods. Promising to give 200 rupees means what kind of bailment is it? What are they trying to say? Amar is giving 50 kg of sugar to Srijit and he's saying, when I come to take back the sugar from you, that time I will give you 200 rupees. So what is Amar trying to say? What kind of goods are these? I mean, what kind of bailment is this? This is a non-gratuitous bailment. There is consideration, basically. It is a non-gratuitous bailment. Okay, fine. Srijit's employee, unaware of this, mixed the 50 kg of sugar belonging to Amar with the sugar in the shop and packaged it for sale when Srijit was away. See, the Bailey is Srijit. Did Srijit himself mix? No. Who mixed? Srijit's employee has mixed. Will that make any difference to you? No. Whether Srijit mixes, whether Srijit's employee mixes, both will be same, because always remember, an employee is an agent of his employer. So if the Srijit's employee is doing something, it's as if Srijit himself has done something. So which means the bailer is Amar. He has given 50 kg of high quality sugar to Srijit and Srijit has mixed the sugar. Tell me, once you mix the sugar, is sugar separable? 50 kg of sugar has been mixed with the sugar in the shop. It is not separable, guys. The sugar is not separable. The sugar is not separable. So which means now what will happen? Tell me, let us think about the whole chart that we just discussed about. Tell me, did the mixing happen with the bailer's consent? The mixing did not happen with the bailer's consent. Now what will you check? Are they separable or are they not separable? Is it separable or is it not separable? It is not separable. If it is not separable, what will we treat? We'll treat as if whole sugar, whole 50 kg sugar itself lost. Entire loss will have to be borne by the Bailey. Come on, continue to read. This came to light only when Amar came asking for the sugar he had bailed with Srijit, as the price of the specific quality of sugar had trebled. So that 50 kg of sugar, its value had become 3 times by now. What is a remedy available to Amar? What will you write? First of all, you will identify this is a bailment contract. Then you will say that who are the parties? Amar is the bailer, Srijit is the bailee, 2 parties over here. Then you will talk about the Bailey's duty. Bailey's duty, he should not mix the bailed goods. But here Srijit has mixed the bailed goods without the bailer's consent and it is not separable. So therefore, whatever is the value of the sugar, that 3 times is the value of the sugar, that entire value is now lost and that entire value has to be borne by the Bailey. Okay, so in case they ask you to calculate, if they give you the value of the sugar and all, let us say long back when Amar had bailed the sugar, at the time of bailment, the 50 kg of sugar was worth 100 rupees per kg. Today, when we got to know about this whole thing, that mixture and all has happened, on that day, the value of the sugar is 300 rupees per kg. So tell me, how much loss will the Bailey bear? Will the Bailey bear the original value or will the Bailey bear the 3 times value which it has become now? The Bailey will bear the 3 times value. Okay, so whatever the value of the goods has become at the time of when you get to know about this, that value, that is the amount of loss which will be borne by the Bailey. We will see what is the total value of the goods lost. That much loss has to be borne by the Bailey. Understood? Yes, guys, this was our fifth question from bailment. Okay, this was all about Bailey's duty to not mix the goods. If the Bailey has mixed the goods, you will check, has he mixed the goods with the consent of the bailer or without the consent of the bailer. If he has mixed it with the consent, then what will you do? Then in the final mixture, both the bailer and the Bailey both will share proportionately. If he mixes without consent, you will check, are they separable or are they not separable? If they are separable, the separation expense who will bear? The separation expense the Bailey will bear. If they are not separable, we will treat as if the entire goods are lost and whatever is the value of the goods lost, that value has to be borne by the Bailey. This you don't have to revise after 20 days again. You will be able to recall and you will be able to apply in the examination properly. Right, guys? Can I take you forward? I hope you're getting benefited. I hope you're getting a good revision of the concepts along with the questions. Right, guys? Come on. Let's go to question number 6. Question number 6, which I have brought for you over here. This is a question from Pledge. And this is a case study based question from Pledge, case study based MCQ, which I have brought over here for you. Okay? So it's all about Pledge. All right. Before we have a look at the big MCQ, let us have a look at the concept involved over here. The concept is about the rights of the pawnee. Who is the pawnee? The pawnee is none other than the pledgee. And who is the pledgee? Is it the money lender or is it the borrower? The pledgee is the money lender, right? So money lender or the banker, whatever. So what are his rights? Number one, he has totally 3 rights, okay? Number one, he can retain the goods. Number one, he can retain the goods. Retain the goods means what? He can exercise the right of lien. He can exercise the right of lien. Number one, he can exercise the right of lien. He can exercise, he can keep my goods till when? Till I don't repay the debt, till I don't repay the interest on the debt, until I don't repay the ordinary expenses, till then he can exercise lien. But he can retain my goods even for subsequent debt. He can retain my goods. He can retain my goods for other debts also, which means general lien, guys. Right? Which means general lien. When will you have general lien? You will have general lien only if it is specifically provided in the contract. See, you can retain my goods till I don't repay the loan, the interest on the loan, and the ordinary expenses. This will come under particular lien. Particular lien is always by default. You will have general lien only if it is specifically mentioned in the contract. So number one, you can retain my goods, you can exercise lien. Number two, you can recover extraordinary expenses. And number three, in case the pawner defaults, who is the pawner? The pawner is a borrower. If the borrower defaults, then in that case, the money lender can either file a suit and also continue to retain the goods, or option 2, the money lender can simply sell away my goods after giving a notice. And after he sells away the goods, if there's a deficiency, he can sue the borrower for the deficiency. If there is a surplus, he will return the surplus to the borrower. Let me give you a little better understanding about this with the help of some examples, and then we will go to the question. Listen carefully, okay? I am explaining the concept to you from scratch. Listen. What are we talking about? We're talking about the rights of the money lender, the rights of the pledger. Rights of the pledgee. Okay, what can he do in a pledge? Imagine the story. Let us say I and the money lender, 2 people in the story. The money lender had given me a loan of rupees 5 lakhs. He had given me one more loan, a loan of rupees 2 lakhs. This 2 lakhs loan is anyways an unsecured loan. But this 5 lakhs loan is a secured loan. And for this 5 lakh loan, I had given to him my car as security. I had given to him. Till here, clear? Okay. Now listen, in this story, this is clearly a pledge contract. I become the pledger and the money lender, he becomes the pledgee. I want to know about the pledgee. The highlight of my story is a pledgee. What can the pledgee do? The first thing that the pledgee can do, he can retain my car. He can retain my car means he can exercise lien. By default, he can exercise which lien? By default, he can exercise particular lien. Till when will he retain my car? Till I don't repay him the loan. Loan of how much? 5 lakh or 2 lakh or both? Till I don't repay the loan of 5 lakhs, till I don't repay the interest on this loan, till I don't repay the ordinary expenses which he has incurred in keeping my car. I had given my car to the money lender. So he would have had to take one parking on rent, one garage on rent, he would have had to take to keep my car, guys. Parking charges, garage charges he would have paid, ordinary expenses he has incurred to preserve my goods. So till I don't repay him all this, till then he will not return my goods. Till then he will not return my car. Till then he can retain my car. Till then he can exercise particular lien. But then he can also exercise general lien. General lien means what? General lien means he can retain my car till I repay to him not only all of this, but also the loan of 2 lakhs. If it is general lien, he can retain my car for this loan also, for this loan also, for both the loans also. Till you are understood? Yes, then tell me, when will you have general lien, everybody? When will you have general lien? You will have general lien only if it is specifically mentioned in the contract only. Then you will have general lien. Even this is clear. Yes, this is the first right of the pledgee. Then coming to the second right of the pledgee, in case he has incurred any extraordinary expenses, whatever extraordinary expenses he has incurred, even those extraordinary expenses he can recover from me. But are you noticing, for extraordinary expenses, can he exercise lien, guys? No, extraordinary expenses, he cannot exercise lien for extraordinary expenses. He can sue me for extraordinary expenses, but he cannot exercise lien for extraordinary expenses. Point number 2. Then coming to point number 3, in case I default, I'm defaulting means what? I'm defaulting means I'm not repaying his loan. If I don't repay his loan, the money lender will have two options. Option number 1, he can file a case against me. He can continue to keep my car and he can file a case against me. Or option number 2, he will first give me a notice, say a warning notice saying, Anushree, repay the loan, otherwise I will sell away your car. He'll give me a notice, and still if I don't pay him the loan back, then he can sell away my car. When he sells away my car, two possibilities are there. Possibility number 1, there might be a deficiency, which means he might have suffered a loss, or there might be a surplus. If there is a surplus, what will he do with the surplus? Surplus, he will have to return the surplus back to me. If there's a deficiency, what will he do? Deficiency, he will sue me for the deficiency. He will sue the pledger for the deficiency. Let us say all of this put together, total 6 lakh rupees he was supposed to recover from me. When he sold away the car, he got 6,50,000 rupees. So that 50,000 rupees surplus he will return back to me. Or let us say when he sold away the car, he was able to get only 5,70,000 rupees. So there was a deficiency of 30,000 rupees. For the 30,000 deficiency, he will sue me. Understood, everybody? Yes. So this was our entire discussion regarding the rights of the moneylender or the rights of the pledgee. Did you understand this? Yes, guys. So with this knowledge, can I take you forward? Can I take you to the question? By the way, I'm hoping that you noticed and that you understood that you can sue and exercise lien, both. Where you can't do both together, there is one place where you can't do both together. In bailment. In bailment, you can either sue or you can exercise lien. You can't do both in bailment. But in pledge, you can do both. In pledge, you can sue me also. You can exercise lien also. You can do both. Is it understood? Yes, guys. So this was our discussion regarding the 3 rights of the moneylender, taking you back to the PDF here. Look at this. So the rights of the moneylender, 3 rights. Number 1, he can retain the goods, which means he can exercise lien. He can exercise particular lien by default. He can exercise general lien, which means he can retain my goods for other debts also, only if it is specifically mentioned in the contract. He can recover extraordinary expenses from me. And in case the borrower defaults, he can either sue and exercise lien, or he can simply sell away the goods after giving notice. If there's a deficiency, he can sue for deficiency. If there's a surplus, he will return the surplus. Now keep this in your mind and look at this question. Look at the question. Let us read it part by part. What exactly has happened over here? Yukti has opened a showroom of electronic goods, that is air conditioner, color TV, refrigerator, washing machine, etc., which are commonly used for household purposes. Okay. She also has a godown in which white goods are stored. Okay. Since the electric items are costly and require heavy investment, she availed a working capital finance from OK Bank Limited, the bank, by pledging the white goods lying in her godown. White goods, nothing but electronic goods. So she wanted a loan, guys. She wanted a working capital loan. She pledged her white goods lying in the godown. So she has pledged her stock and she is getting a loan from whom? From OK Bank Limited. Now what happened? The bank put its lock on the godown, and the whole of white goods were now in the possession of the bank. So there is a proper pledge of goods over here. The bank granted a working capital finance of 100 lakh rupees to Yukti by keeping the pledged goods. The drawing power was kept as 60% of the value of the goods pledged. So how much loan has a bank given to Yukti? 100 lakh rupees loan the bank has given. A lot of irrelevant information is there. 60% of the value, all that not even relevant. Come to the next part. As and when Yukti needs to withdraw some white goods from the godown, she requests the bank deposits the value of the goods to be withdrawn. A godown keeper of the bank comes with her, opens a lock of the godown and allows Yukti to draw the specified goods of which she has made payment to the bank. Understanding? So basically, initially, she wanted 100 lakh rupees working capital loan. So she gave her white goods, whatever she had, her stock in trade, her electronic items, she gave it as a security to the bank, and the bank has given her the loan. Now, as and when she repays little loan to the bank, little the bank releases her assets, releases her securities. The bank got comprehensive insurance policy on the value of the goods pledged to cover it from theft, fire, flood, and earthquake, etc. Yukti, after some time, availed another loan of 20 lakhs from the same bank for her sister's marriage. This was a personal loan and no security was insisted by the bank. So totally, can you tell me, totally how many loans are there, guys? Totally 2 loans are there, right? One loan is a working capital loan, which is a secured loan. Second loan is this marriage loan, which is an unsecured loan. Then what happened? Yukti hired a locker from the bank in which she kept some jewelry, which was to be given to her sister on her marriage. After a year, Yukti decided to transfer its running business to Shekhar, for which Shekhar paid the amount to Yukti as agreed between them. So Yukti has also hired one locker from the bank to keep jewelry, and also Yukti has sold her business later to Shekhar. Yukti thereafter repaid all the outstanding loan amount given by the bank towards a working capital finance and asked the bank to open the lock of the godown to get goods in order to hand over the same to Shekhar. Understanding? She sold away her business to Shekhar, right? So she has to give all her stock in trade to Shekhar. But where is the stock in trade? Stock in trade is under the bank's control because she has given the stock in trade as security for working capital loan. So she is willing to repay the whole working capital loan. She's asking the banker to release her goods so that she can give off those goods to Shekhar and leave. But however, there was some dispute over the insurance charges paid by the bank. Which insurance charges? Remember, we just now saw that the banker had taken one insurance policy on those goods to protect those goods from theft, fire, flood, earthquake. So about that, okay. The question says that the bank insisted to first pay the interest amount, then only it will allow her to remove the goods. Bank also asked Yukti to settle her personal loan, and only thereafter the bank will allow to take the goods lying in the godown. Is this right, guys? Can the bank say, pay insurance charges, only then I will let you take the goods? Yes, insurance charges will become ordinary expenses. Ordinary expenses incurred to protect the goods. So for ordinary expenses also, the bank can exercise lien, I taught you. Right? Just now we discussed. Then tell me, can the banker say you have to pay the interest money? Only then I will let you take away the goods. Can the banker say that? Yes, the banker can say that also, because even for interest he can exercise lien. But tell me, can the banker say you have to repay that second personal loan also? Only then I will let you take away the goods? That the banker can't say. Right, that the banker can't say. Why? Because when can you exit? Don't you think that will become general lien? Don't you think that will become general lien? General lien, when can you exercise? Only if it is specifically mentioned in the contract. Was it mentioned in the contract? No, question is silent. So for C, for insurance, bank can keep. For interest, bank can keep. For the working capital loan also, bank can keep. Particular lien by default bank can enjoy, but bank no general lien for you. You can't exercise general lien until it is specifically mentioned. So for the personal loan, you can't keep. Okay, now keep all these concepts in mind and look at the first question. In the light of the given facts, state which statement is correct. Which statement is correct? When the outstanding amount taken for working capital has been paid, the bank cannot retain the goods. The bank can retain the goods till all charges, including interest, insurance, other charges are paid by Yukti. See, the first sentence is definitely not right, because first sentence is talking only about the loan. But actually, banker can also retain for interest, other charges and all. So second sentence, first of all, sounds right. Third, the bank can retain only a portion of the goods to cover its dues and may release the rest of the goods. No, the banker may first release the goods and then for recovery file suit. No, we discussed that the banker can sue and exercise lien. The banker can do both. So the correct answer is going to be option B. The banker can retain the goods till all the charges, interest, insurance, everything is paid by Yukti. Then second question, if in the given case, Yukti pays all expenses, including disputed insurance premium, all the expenses she has paid. But the bank is insisting to clear the personal loan account. Then only it will release the goods. Determine whether the bank is entitled to do so. We just discussed, guys. Can the bank keep her goods for personal loan also? No. So it's definitely not yes. Bank can sell the part amount of the goods lying in the godown to liquidate the personal loan? No. Bank can ask Shaker to give guarantee. Why is Shaker coming into the picture? No. So the correct answer is no. The bank has no right to retain the goods pledged with it, since personal loan was not taken on the security of such goods. The banker does not have general lien unless it is specifically mentioned in the contract. Then coming to the third question, Yukti disputed the amount demanded by the bank towards the insurance premium. Listen to this, okay? This is very interesting. Yukti disputed the amount demanded by the bank towards the insurance premium paid by the bank. Yukti emphasized that there was no need to take insurance policy on the goods pledged because it is an extra burden on the part of the borrower. Can she say that? No, insurance is ordinary expense incurred to protect the goods. It is general policy that insurance will be taken to protect the goods. So therefore, Yukti cannot say, why are you taking this extra burden on me? Right? This is a general practice to take insurance on goods to protect them from loss. So this is ordinary expense incurred to preserve the goods. Therefore, bank can incur this expense. So which of the sentences is correct? Yes, it is an extra financial burden. No. Then every bank has a policy to get the security insured on which it grants loan. So in this case also, bank for the purpose of protection of the goods took the insurance policy. Sounds right? Generally, every bank has a policy. This is more of a general knowledge question. Third point, the godown is just nearby the police station. Hence, there should not be fear of theft. Of course not. Happening of earthquake and flood are remote possibility. So expenses on insurance premium could have been avoided as it is not a mandatory requirement. No, insurance is a general policy. Insurance is always taken by the banker whenever you give your asset as security. So option B. Then coming to the last question, very simple question. When Yukti is availing the working capital finance from the bank on the security of the white goods by submitting these goods in the custody of the bank, said course of transaction can be termed as what? After all this drama, now I'm asking you, what kind of a special contract is it? Obviously, it is pledge of goods. Obviously. Right, guys? Crystal clear with this discussion also? Yes, this was question number 6. This question was also from your pledge discussion from your special contracts chapter. Okay, now can I take you to the next discussion? Can I take you to the next question? Come on, you guys, let's go to question number 7. So question number 7 is a question from agency. All right, agency by necessity. Let me quickly give you a revision. What is agency by necessity? Agency by necessity arises only in emergency situations. See, in normal situations, the agent can do only those things which he is authorized to do. If the agent does anything which he is not authorized to do, the principal will not be bound. That is in general situations. However, in emergency situation, the agent suddenly gets a superpower. The agent can do anything under the sun. He can do anything, but what should his objective be? He can do anything in an emergency situation, even those things which he is not authorized to do. He can do anything, but what should his objective be? His objective should be to save the principal from loss. His objective should be to protect the principal from loss. This is agency by necessity. So whenever there's an emergency situation, automatically agency by necessity will get created, and under agency by necessity, the agent can do anything to protect the principal from loss, even those things which he is not authorized to do. He can do all those things. Now, what are the conditions to be satisfied to be called an agency, to be called an emergency? When will you call it an emergency situation? When will you call it as an emergency situation? See, you will call it as an emergency situation if all these 5 conditions are fulfilled. First of all, the agent is not able to communicate with the principal within the available time. Then there's an actual and definite commercial necessity. Agent has acted bona fide and in the benefit of the principal. Agent has adopted the most reasonable and practicable course under the circumstance. Agent has possession of the goods. We'll try to understand this particular concept a little better by taking one example. Imagine I wanted to send some apples to you. Okay, now I am in Bangalore and you are in Chennai. So I appointed one truck operator as my agent. I told this truck operator to transport my apples to you. Okay, now what happened is on the way, there was heavy rainfall and the truck got stranded in the rainfall. The truck driver is calling me to ask me what to do because the truck is stuck in the rain. But he's trying to call me, but he's not able to communicate with me. He's not able to reach with me because of heavy rainfall, bad network. He is not able to reach me. Now the truck driver has to do something immediately because apples, they are perishable goods, right? So if he keeps waiting for the rain to stop, then by then the apples might get rotten. So therefore, there is commercial necessity. Commercial necessity means business point of view, there's a requirement to act promptly. If you don't act promptly, then there will be a heavy loss. So what the agent did, what this truck operator did, he tried reaching me. He was not able to reach me because of bad network. There's a commercial necessity for him to act promptly because if he doesn't act promptly, my apples will get destroyed and I will suffer a huge loss. So what he did is, instead of taking those apples to the Chennai market, nearby where he was stuck, nearby there was a small village. He went to that village and he sold away those apples over there. He got a less price only because he's selling in the village. He got a less price only, but then at least he was able to sell away the apples and get some money at least. So what did the agent do? The agent did something bona fide, and for my benefit he did. He took the most reasonable and practicable course. Anybody in his place would have done this. He took the most reasonable and practicable course, and the agent only has possession of my goods. So if all these conditions are fulfilled, it becomes an emergency situation. Now tell me, did the truck operator, did the agent have the right to sell away the apples? No, his only work was to transport. But did he have the right to sell away the apples? No. But because an emergency is existing, he can do anything. He can even do those things for which he has no authority. I will be bound. Later, can I say, why did you sell away the apples? I can't say that because this was an emergency situation. Automatically, agency by necessity will get created. In agency by necessity, he can do anything to protect me from loss. I will be bound. Understood, everybody? Yes, with this in your mind, have a look at this question. Very easily, you will be able to answer. Rahul, a transporter, was entrusted with the duty of transporting tomatoes from a rural farm to a city by Ashwin. Due to heavy rains, Rahul was stranded for more than 2 days. Rahul sold the tomatoes below the market rate in the nearby market where he was stranded, fearing that the tomatoes may perish. Guys, exactly same thing like the example I told you. Can Ashwin recover the loss from Rahul on the ground that Rahul had acted beyond authority? Yes or no? Can Ashwin recover the loss from Rahul on the ground that Rahul had acted beyond his authority? No. Here, Rahul is the agent. Ashwin is the principal. Ashwin is telling Rahul, the agent, to do the delivery of the tomatoes, do the transportation of the tomatoes. On the way, Rahul gets struck. So therefore, Rahul sells away the tomatoes in the nearby market at below the market rate. So tell me, does Rahul have the authority to do this? In reality, does Rahul have the authority to do this? No. But don't you think this is an emergency case? We will assume he was not able to communicate because he was stuck. So we'll assume he was not able to communicate. They are tomatoes, they are perishable. So therefore, there is commercial necessity to act promptly. And tell me, has Rahul done anything which is absurd? Has done anything which is weird? No, he's acted bona fide. For the principal's benefit only, he has acted. He has done something which is most reasonable and practicable in that particular situation, and he has the possession of goods. All conditions are fulfilled. All conditions are fulfilled over here. Therefore, this is an agency by necessity. Even though Rahul has done something for which he has no authority to do, still the principal will be bound. Later, the principal cannot say that because of you, I suffered a loss. No, in fact, Rahul protected him from the loss. Understood, everybody? Yes, this was question number 7, agency by necessity and emergency. Okay, come to question number 8 now. Question number 8 is another simple question. This is again a question from agency. So look at this question now. Explain whether the agency shall be terminated in the following cases. We're talking about termination of agency. A gives authority to B to sell A's land and to pay himself out of the proceeds the debts due to him from A. What does this mean? A owes money to B. A has a land. A wants to sell away this land. To sell away this land, A is appointing B as agent. A is telling B, you sell away my land, whatever money you get from the sale of land, from that you take the money which I owe you and you give me the balance. Any concept that immediately comes to your mind as soon as you read this? This is nothing but agency coupled with interest, guys. This is nothing but agency which is coupled with interest. How come? Because the agent has interest in the property, which is a subject matter of agency. See, whenever you get a question regarding agency coupled with interest, this is a key sentence which has to be a part of your answer. What is agency coupled with interest? Agent has interest in the property, which is a subject matter of the agency. If it is agency coupled with interest, then the agency cannot be terminated. That is, the agency becomes an irrevocable agency. It becomes an agency which can't be cancelled, right, guys? So here in this particular example, A is the principal and B is the agent, right? B is having personal interest in the sale of land, because only through the sale of land he will be able to recover his loan, right? So B is having personal interest in this transaction. So this is definitely an agency coupled with interest, because agent has interest in the property, which is a subject matter of the agency. Come on, repeat this part one last time with me. Agent has interest in the property, which is a subject matter of agency. Agent has interest in the property, which is subject matter of agency. So agent B has interest in this sale of land, which is a subject matter of this agency. So if the agency is agency coupled with interest, then the agency becomes an irrevocable agency. Sorry, it cannot be terminated. Even if A becomes insane, even if the principal becomes insane, still this agency cannot be terminated. It becomes an irrevocable agency. Right, guys? It becomes an irrevocable agency. In two cases, agency becomes irrevocable agency. Number one, if it is agency coupled with interest, and number two, if the agent has already exercised authority. What do you mean by agent has already exercised authority? Agent has already exercised authority means agent has already done the work which I asked him to do. Like here, if B has already sold the land, can we now cancel the agency? No, right? So when does agency become irrevocable? Agency becomes irrevocable in only two cases. Number one, if it is agency which is coupled with interest, which means even the agent is having interest in that whole transaction. Agency is coupled with interest, number one. And what is number two? Number two, if the agent has already exercised authority. Agent has already exercised authority. In these two cases, it becomes an irrevocable agency, which means you can't cancel the agency. That is the first point. Now coming to the second point, A appoints B as A's agent to sell A's land. B, under the authority of A, appoints C as agent of B. So B is appointing C. Afterwards, A revokes the authority of B, but not of C. What is the status of agency of C? A appoints B. B is delegating the work to C. So what does C become? C becomes sub-agent, guys. C becomes sub-agent. Can sub-agent be appointed under the authority of principal? Yes, this is nothing but proper appointment of sub-agent. Do you remember learning? See, first of all, can we appoint sub-agent? Tell me. Generally, we can't appoint sub-agent because delegatus non potest delegare. Do you remember learning that? Delegatee cannot further delegate, so we can't appoint sub-agent. But there are three exceptional cases where we can appoint sub-agent. Right, when it if it is a custom of trade, usage of trade, or if in the terms of appointment it is allowed. If it's an emergency situation, then also we can appoint sub-agent. So generally we can't appoint sub-agent, but we do have the concept of proper appointment of sub-agent. So this is a case of proper appointment of sub-agent. With A's permission only, B is appointing sub-agent. Okay, now listen, A cancelled B's appointment. Whenever the agent's appointment is cancelled, automatically even sub-agent's appointment will get cancelled. If the look at this sentence over here. Termination of agency amounts to termination of sub-agency also. If I terminate agency, automatically even sub-agency will come to an end. Understanding? Here, Mr. A had appointed B as agent, B had appointed C as sub-agent. A cancelled B's appointment. When agent's appointment is cancelled, automatically even sub-agent's appointment will get cancelled. Right, guys? So this was question number 8. Question number 8 was all about termination of agency. So through question number 8, we have also learned two cases where agency is irrevocable. When is agency irrevocable, guys? What are the two cases? Number one, if it is agency coupled with interest, and number two, if the agent has already exercised authority. What do you mean by agency coupled with interest? It means that agent has interest in the property, which is the subject matter of agency. Is this sentence in your memory? Agent has interest in the property, which is the subject matter of agency. Clear? Can I close this question? Yes, guys, with this, we are done with the special contract related questions also. So we are done with one question from share capital, then we did one question from CSR, and then we've done 2 questions from bailment, 2 questions from guarantee, one that big MCQ from pledge, and we've seen 2 to 3 questions from agency. Now we'll go to the Negotiable Instruments Act. Before we go to the Negotiable Instruments Act, we will take an exact 5 minutes pause, and that's when we will resume. Okay, exact 5 minutes pause. Even I will be back, even you will come back. So come on, let's go to the 9th question now. Let's read the question and then we'll discuss it. This is a very interesting question. Through this one question, multiple concepts are covered. The concept of HIDC, the concept of not negotiable crossing, okay, the concept of inchoate instrument. So we have 3 concepts in this one question itself. See, first of all, who is HIDC? Who is HIDC? He's a person who got the instrument for consideration. He got the instrument before maturity of the instrument, and he got the instrument in good faith. He has no idea that the transferor's title is bad. If you're a HIDC, what kind of a title do you get? If you're a HIDC, you get a good title. Even if the transferor's title is bad, you still get a good title. Then what do you mean by not negotiable crossing? On the check, if I write the word not negotiable means, it doesn't mean it is not transferable. It is still transferable. Not negotiable crossing just means that, sorry, HIDC, even though you're HIDC, you will not automatically get good title. Your title will depend upon the transferor's title. Tell me, if I write not negotiable, am I saying that HIDC is going to get a bad title? No, I am not saying this. I am saying HIDC, your title will depend upon what? Your title will depend upon the transferor's title. If the transferor has a good title, even you will get good title. If the transferor has bad title, even you will get bad title. See, generally, HIDC automatically gets a good title. But on the check, if not negotiable is written, then HIDC's title will depend upon the transferor's title. If HIDC has a good title, if the transferor has a good title, then HIDC also will have good title. If the transferor has a bad title, even HIDC will have a bad title. Okay, so 2 points revised. What is HIDC and what is not negotiable crossing? Then listen, what is inchoate instrument? An inchoate instrument is an instrument which is an incomplete instrument. It is signed, stamped, delivered, either wholly blank or it has some incomplete details. Signed, stamped, delivered, either it is fully blank or it has some incomplete details. When will this incomplete instrument become valid? Only if it is completed, it will become valid. Let us say you were supposed to write only 5,000 on the instrument. It was a blank check. It was an incomplete check. You were supposed to write amount 5,000, but you wrote 7,000 rupees. You wrote extra amount. So if this check goes to HIDC, how much will you have to pay? HIDC will have the right to receive full 7,000. But if it goes to just a holder, to a person who is not HIDC, that person will have the right to get only 5,000. Right, guys? So this is the concept which is involved in the question. Now let us have a look at the question. Only one single reading and we have to be able to answer the question. The question says, Mr. A signs his name on a blank check with not negotiable crossing, which he gives to B. Let us put it down over here. So what has happened? We have this person, Mr. A. Mr. A signs his name on a blank check with not negotiable crossing and he gives it to B. So A is giving a check to B. On this check, not negotiable crossing is done and this check is a blank check. On this check, amount is not written with an authority to fill up a sum of 3,000 only. So what is the rightful amount, guys? How much amount should be filled into this check? Only 3,000 should be filled into this check. But what did B do? B fills it for 5,000 rupees. So clearly B has done something wrong over here. B has filled in for 5,000 rupees. B then endorsed it to C for a consideration of 5,000, who takes it in good faith. So B passes on the instrument to C. Now C took the instrument for consideration. C took the instrument in good faith, and assuming C took the instrument within 3 months, within the maturity of the instrument, what does C become? C becomes HIDC. Right? Examine whether C is entitled to recover the full amount of the instrument. Tell me, what is C's right? C is HIDC. How much amount can C get on the instrument? Can he get 3,000 or can he get 5,000? Come on, tell me quickly. C can get only 3,000 rupees on this instrument. Why 3,000, guys? No doubt C is HIDC. No doubt C is HIDC, but on this instrument, not negotiable is written. Not negotiable means, sorry HIDC, your title will depend upon transferor's title. What is B's title? Tell me. B has title on how much? B has the right to recover how much? B has the right to recover only the rightful amount of 3,000. So B has title for 3,000. Even C will have title for 3,000 only. Not negotiable is written. So sorry HIDC, even though you are HIDC, whatever is the transferor's title, that much title only even you will have. But guys, the same thing, if I copy and paste the same thing, just one small difference, okay? What if it was not marked not negotiable? If not negotiable was not written, then tell me how much money HIDC could have taken. In that case, see, you are HIDC. You will get good title. You will get the right to receive the whole 5,000 rupees. That's all. Understood, everybody? That is this question. So this question has how many concepts involved? Inchoate instrument concept, it is incomplete. Then number 2, the HIDC concept. And number 3, not negotiable. 3 concepts got revised for you through this one question. This was a very recent November 2022 mock test paper question only. Okay, I'll go to the next question. The next question from Negotiable Instruments Act, question number 10. Question number 10 is an old question. It's a November 2018 mock test paper question. Now listen carefully. This is an important question. Through this one question, multiple concepts will get revised. Okay, this question has totally 4 subdivisions. Okay, each of these 4 subdivisions will have to give an independent answer. Look at these questions one by one. First question, A draws a check in favor of M, a minor. M endorses the same in favor of X. So, A has given the check to M. M happens to be a minor. What did M do? M passed it to X. Is this okay? Can minor be a party to the negotiable instrument? Will the negotiable instrument remain valid? Yes. Even if a minor is a party to the negotiable instrument will still stay valid. But tell me, anything goes wrong later, will the minor have any liability? No. Only thing that the minor will not have any liability. Other parties will continue to remain liable, but right, other parties will continue to remain liable. Only this minor will not have any liability. Negotiable instrument will continue to remain valid. So, A has given the check to M. M is a minor and M has passed it on to X. Now, the check got dishonored on the grounds of inadequate funds. Discuss the rights of X. Tell me, what right does X have? Can X sue M? Can X sue M? No. So, what will X do? X, you have only one option. You can only sue A. You can only sue A. That is my first subdivision, everybody. Right, now look at the second subdivision. A promissory note was made without mentioning any time for payment. Time for payment was not mentioned. See, on the instrument, if date of payment is not written, then what do we assume? Is it a time instrument or is it a demand instrument? If no date for payment is mentioned, we assume it is payable on demand. Guys, if nothing is mentioned, holder added the words on demand. Does it become material alteration now? Nothing was written, okay? Nothing, no time for payment, nothing was written. Later, the holder is writing on the instrument payable on demand. Tell me, by writing this, did the holder change the nature of the instrument itself? Did he change anything by writing these words? He changed nothing. Even earlier it was demand instrument, even now it is going to be a demand instrument. Right, guys? So is this material alteration? No, this is not material alteration. Then the next point, listen, this next point was asked in the December 2021 examination also. Listen, A draws a check for 1,000 rupees and hands it over to B by way of gift. So A is giving a gift check to B. Can I call B as holder in due course? Does B become holder in due course, guys? No, B is not going to be a holder in due course, right? Why? What is missing? What is missing? Why is he not a holder in due course? Consideration is missing. There is no consideration. So B can't be holder in due course. But can I call B holder at least? Okay, he is not holder in due course, but he is holder in at least. Why is he holder? Because he has the right in his own name to receive money on the instrument. He has the right in his own name to keep the instrument. See, guys, once I give a gift to you, Can I tell you, hey, please give it back to me? No, once I give the gift to you, it's become yours now. You have the right over the gift. I don't have any right over the gift anymore. So once A gives a gift to B, it has become B's gift. Okay, fine. B is not holder in due course, but B is still a holder, guys. As a holder, he has the right to receive money on the instrument. As a holder, he has the right to possess the instrument. He has the right to get money on the instrument. What is the only problem for holder? What's the only problem for holder? Holder, you will not automatically get good title. Your title will depend upon transferor's title. If transferor has good title, only then you will get good title. If transferor has bad title, even you will get bad title. That's the only disadvantage for the holder. Agreed. That's the only disadvantage for the holder. So therefore, is B a holder in due course? No, B, sorry, you are not holder in due course. There is no consideration. You are just holder. Explain whether he has right to receive proceeds of the check. Yes, you do have the right to receive proceeds of the check because you are a holder. As a holder, you are entitled to possess the instrument. You are entitled to receive money on the instrument. Okay, guys, if you're noticing, for all these questions, for each and every question, whatever concept was involved, I have put the concept also in this file, okay? So that when you're revising or running through this again the day before the exam or something, you don't have to keep flipping and, keep finding keep searching for the concept. So make proper solid use of this file. Lot of concepts you will find over here. And all the concepts in this file, each and every concept is going to be very, very important. Okay, then look at the last subdivision. A check is drawn payable to B or order. It is stolen and the thief forges B's endorsement and endorses it to C. Guys, there is forgery. The bank pays the check in due course. Whether B can recover the money from the banker. Let me explain this to you. A very interesting point. Many students generally are not even aware of the existence of this point. Most of the students, as soon as they see the word forgery, immediately what does the brain say automatically? Nullity, forgery, nullity, HIDC also, absence of title, nobody will get good title, HIDC, even you will not get good title. This is what the brain automatically immediately says. But relating to forgery, actually there is one more concept. Listen, what has happened over here? There is a check. Some person has drawn this check. And this some person, Mr. Blue, is a drawer of the check. It is drawn payable to B or order, which means B is the payee of the check. Right now, B is the holder of the check. So there is a check which is payable to B. This check got stolen away. Okay, let us say one fraud fellow, Red, stole the check. He forged B's endorsement to C, which means he is pretending as if B is endorsing this check to C. In reality, did B do any endorsement? No. What Red has done is that on this instrument, he has written to C and Red has put B's signature as if B is signing. In reality, B has not done it. So B to C, this is a forged endorsement. Does everybody agree? Because did B put his signature himself? No. Some other person, the person who did the theft, this person, Mr. Red, he has done the forgery. He has signed, pretending as if B is signing. He has done a forgery over here. Okay, he forged it and gave it to Mr. C. Now what happened? Mr. C presented this check to the drawee banker. Now think from the drawee banker's point of view, will the drawee banker know that B's signature is forged? See, the drawee banker knows whose signature? The drawee banker knows drawer's signature. But does the drawee banker know the rest of the world's signature? No. So the drawee banker looks at the check. The drawee banker thinks everything is looking fine. So the drawee banker makes a payment in due course to Mr. C. But tell me, in reality, should C get money on the check? Don't you think C over here has bad title, guys? C has bad title here. Why C has bad title? Because there is forgery. Forgery is equal to nullity. Nobody has a right to receive any money. There is absence of title. Even if C is HIDC, still everybody will get bad title. C, even you will have bad title. So actually C has no right to receive money, but still C got the money. So the question is, can we sue the drawee banker? Can B sue the drawee banker? The drawee banker, why did you pay the money? There is forgery, no? It is nullity, no? So you shouldn't have paid the money, right? Why did you pay the money? Like that, can B sue drawee banker? The answer is no. No. Why not, guys? What does the law say? The law says if there is a check, and on this check, if there is a forged signature, there is a check, and if that check has a forged signature, and if the drawee banker has made a payment in due course. 3 conditions, okay? What are the 3 conditions? The 3 conditions, first condition is that there is a check. That check has a forged signature, and the drawee banker has made a payment in due course. So 3 conditions. If all these 3 conditions are fulfilled, then you will check that whose signature is forged. 2 things are possible. Either the drawer's signature is forged or some other party's signature is forged. If the drawer's signature is forged, then yes, the drawee banker is going to be liable, because drawee banker, you should know your customer's signature. You should know the drawer's signature. But if any of the party's signature is forged, then in that case, the drawee banker is not liable. So in this story over here, whose signature was forged? Was a drawer's signature forged? No, somebody else's signature was forged. So the drawee banker will be protected. The drawee banker cannot be sued for this. The drawee banker will be protected. But tell me, so what can B do now? B can't sue the drawee banker. Drawee banker is protected. What will B do? B will sue whom? B will sue C, and B will get the money back from C, because C does not have the right to receive money. If C has received the money, C does not have the right to retain the money. Right, guys? See, I'll show you one point over here. Look at this. Look, read this along with me, okay? Even if he happens to receive the payment against such an instrument, he cannot retain the money. He may be sued on tort by the person who is truly entitled to the money. Tell me, in this example, who is the person who actually has a right to get the money? B is the person who is truly entitled to receive money on this instrument, guys. B is the person who has a right to receive money on this instrument. So B can directly sue C, because C has no right to get money on this instrument. There is forgery. C does not have good title. C does not have the right to get any money on the instrument. And whatever money C has by chance received on this instrument, C can't retain the money. If C retains the money, then B, the person who has the right to get money on this instrument, this B can sue C. Can sue C on tort. Understanding? Yes. So this was a very interesting question. Question number 10, covering 4 solid subdivisions from the Negotiable Instruments Act. Okay. So what are the concepts that were revised through this one question? 4 concepts got revised, guys. Minor concept. Then if nothing is written on the instrument, we will assume it is payable on demand. And now, if the holder is going to write payable on demand, he is not changing the nature of the instrument. Even earlier demand instrument, even now demand instrument. So I can't call it as material alteration. Third concept we learned here, holder in due course, that discussion we had. And the last concept we had now, we discussed about forgery also, and we also discussed about protecting the drawee banker. All these concepts still here clear? Can I take you to the 11th question? Let's proceed, guys. These were our first 10 questions. Come on, let's go to the 11th question. Again, one more question from negotiable instruments only. Simple question, yet a very important question. Section number 138 of your Negotiable Instruments Act, extremely important. Just like how I told you, from CSR for sure you will get a question in the upcoming examination. Same way, mark section 138. Your dishonor of check section, even from here, 99% you will get a question in the examination. Listen carefully. The question says, Mr. Harsha donated 50,000 rupees to an NGO by check for sponsoring the education of one child for 1 year. Later on, he found that the NGO was a fraud and did not engage in philanthropic activities. He gave a stop payment instruction to his bankers, and the check was not honored by the bank as per his instructions. NGO has sent a demand notice and threatened to file a case against Harsha. Advise Mr. Harsha about the course of action available under the Negotiable Instruments Act 1881. So this question is all about dishonor of check, section 138. Let me give you a revision of section 138. What does section 138 say? 138 says if the check is dishonored, okay, just listen to me, just listen carefully, just do not read this whole thing, just read along with me, whatever I'm circling, whatever I'm highlighting, just read that for now with me. Listen, if the check is dishonored, why did the check got dishonored? Either because there is insufficient funds, or the amount of the check is more than my arrangement with the banker. The check got dishonored, either the check got dishonored because of insufficient funds, or the check got dishonored because the amount of the check was more than my arrangement with the banker. Always remember, insufficient funds also indirectly includes stop payment order. What is stop payment order? Stop payment order is also called as countermanding payment. Here what happens is, once I give the check to you, see, as soon as I give the check to you, what am I saying indirectly? As soon as I give the check to you, indirectly, I am admitting that I am liable towards you. Once I give the check to you, once I accept my liability towards you, if I call the banker and if I tell the banker, listen, banker, stop payment, don't make payment on this check. Once I give the check to you, once I accept my liability towards you, if I'm going to tell the banker not to make payment to you, it is as if I don't want to honor my liability. If I make a stop payment order, it is as good as dishonoring the check. It is as good as dishonoring the check because of insufficient funds. So insufficient funds includes even stop payment order, even countermanding payment, even that comes under insufficient funds, because I am first giving the check to you. I am first admitting my liability towards you, and then I'm telling the banker not to make payment on this check, which means I'm accepting my liability, but I don't want to make payment on the check. This is as good as insufficient funds. Even this comes under dishonor of checks. So in case the check got dishonored because of insufficient funds, because of stop payment or countermanding payment, or because the amount of the check was more than my arrangement with the banker, because of these three reasons, if the check gets dishonored, then only section 138 applies. Otherwise, section 138 doesn't apply. Any other reason if the check is dishonored, like stale check, section 138 will not apply. Signature is not matching, section 138 will not apply. Amount in words not matching, section 138 will not apply. So section 138 will not apply in each and every section 138 will not apply in each and every dishonor. It will apply only in those dishonors which are because of insufficient funds, which is because of stop payment or countermanding payment, which is because the amount of the check is more than my arrangement with the banker. So in these three cases, section 138 will apply. And what does section 138 say? Section 138 says that as soon as the dishonor happens, the drawee banker will inform the payee that the dishonor has happened. The drawee banker will inform the payee that dishonor has happened. Now, the payee has to send a notice to the drawer. The payee has to send a notice to the drawer within 30 days and will have to ask the drawer to make the payment to the payee. Make the payment within how many days? Make the payment within 15 days. If the drawer makes the payment within 15 days, great, the story will end. But if the drawer does not make the payment within 15 days, then in that case, the payee can file a case against the drawer. The payee can file a complaint against the drawer within the next 30 days. Once a case is filed, once a court convicts the drawer will be punished. He'll be punished with imprisonment maximum 2 years, or he will be imprisoned with fine maximum 2 times the amount of the check, or both. All offenses under the Negotiable Instrument Act are compoundable offenses. What is the punishment here? Imprisonment maximum 2 years, or fine maximum 2 times the amount of the check, or both. But the whole of section 138 is not applicable to gift check. Understanding, guys? Are you clear with the whole summary of section 138? One last revision of section 138. Listen carefully. Very, very important section, guys. So come on, sit up straight. No getting tired already. No, we will sleep all we want after the exams are over. Come on. If you're going to pay attention, if you're going to, try to grasp as much as you can. If you can tell yourself, after I finish the session with you, if you are able to tell yourself that yes, these 3 hours or whatever time I take from you, this evening today was very, very productive. If you're able to tell yourself that, I gave my best, okay, you're going to feel so nice, you're going to feel so confident, right, guys? And I'm very sure which are the days when you are the happiest in these days, in this month of October. Which day would have been the happiest day for you? The day when you studied a lot, or the day when you studied the least? The day on which you've studied a lot, that would have been the day that would have given you the most amount of happiness and the most amount of satisfaction. Right, guys? So that is the stage we are in right now, right? So come on, you owe this to yourselves, all right? Come on, we are not getting tired so easily. We have a long way to go. Come on, you guys. Section 138. Section 138 says check got dishonored. Why did the check get dishonored? Either because of insufficient funds, or the check got dishonored because of stop payment order or countermanding payment, or the check got dishonored because the amount of the check was more than my arrangement with the banker. Because of these three reasons, the check got dishonored. So what will happen now? The drawee banker will send a notice to the payee about this. The drawee banker will inform about the dishonor to the payee. The payee will send a notice to the drawer and will ask him for payment. The payee has to send this notice within 30 days, and the drawer has to make the payment within 15 days. If the drawer does not make the payment within 15 days, then within the next 30 days, the payee can file a complaint against the drawer. Now, once the complaint is filed, once a court convicts the drawer that yes, the drawer is guilty, then the drawer will be punished. What will be the punishment? Imprisonment or fine or both. How much imprisonment? Maximum 2 years. How much fine? Maximum 2 times the amount of the check. Imprisonment or fine or both. But this whole section 138 is not applicable to gift check. Coming to question number 11. Over here, there is a dishonor, guys. There is stop payment. Stop payment comes under section 138 dishonor. Do you agree? 138 does not cover every dishonor. It covers only 3 dishonors. What are the 3 dishonors? Dishonor because of insufficient funds, dishonor because of stop payment or countermanding payment, dishonor because the amount of the check is more than my arrangement with the banker. So here, stop payment comes under section 138 dishonor. But this was a donation, which means this was a gift check. So because this was a gift check, will section 138 procedure apply here? The whole of section 138 procedure itself will not apply here. Are we understanding, everybody? The whole of section 138 procedure itself is not applicable over here because this is a gift check. So that is what this question is about. So you will not even have to write this whole process. You will say simply section 138 will not apply because it is a gift check. But it's a 3 marks question. So at least a little bit you'll have to elaborate a little bit about the 30 days, 15 days, 30 days you'll have to write about. You'll have to write about stop payment and all. You'll have to mention that because it is a dishonor, even stop payment comes under dishonor. You'll have to first of all justify that. But however, section 138 process is not applicable to gift checks. Okay, MCQ point of view, please remember all the offenses under the Negotiable Instrument Act, all the offenses are compoundable offenses. Perfect understanding. Can I take you to the next question? Yes, guys. So with this, we are done with the Negotiable Instruments Act. And now I'm coming back to our company law. We have to do General Clauses Act and interpretation of statutes also. That will come from question number 13 onwards. In between question number 12, one question from the meetings chapter I have squeezed in between. Simple question only, a question relating to quorum. Okay. So what are the concepts we have discussed about till now? Accounts of companies, CSR. Then we've spoken about debentures from the share capital chapter. Then we've seen about principal debtor can be a minor, coextensive nature of surety's liability we've discussed. We've discussed if the principal debtor does something, if the creditor does something, does some act or omission, because of which principal debtor is discharged, automatically even surety will get discharged. Then we have also discussed about the concept of mixing of the bailed goods. We should not mix the bailed goods. Then we have discussed about pledge in full detail. Then we have discussed about agency by necessity, emergency situations and all we've discussed. Irrevocable agency, we've spoken about that. Inchoate instrument, HIDC, not negotiable crossing, minors concept, demand instrument, time instrument, holder concept, holder in due course, protecting the banker, and finally section 138. Okay, come on. Let's go to question number 12 now. Question number 12 is this one question from meetings chapter which I wanted to discuss with you. It is relating to quorum, guys. Before I discuss the question with you, let us have a look at the concept. What do you mean by quorum? Quorum is nothing but the minimum number of members who must be present. Only that minimum number of members is present, only then we can start the meeting. If the minimum number is not present, we can't even commence a meeting, we can't even start the meeting. So we can commence a meeting only when that minimum number of members is present. Now, how many minimum number of members? If it's a private company, only two we need. If it's a public company, there it will depend upon the total number of members in the company. If it's a public company, if the company has up to 1,000 members, then quorum is 5. If more than 1,000 up to 5,000, quorum is 15. More than 5,000, quorum is 30. So 5, 15, 30. Up to 1,000, more than 1,000 but up to 5,000, and more than 5,000. 5, 15, 30. Up to 1,000, more than 1,000 but up to 5,000, and more than 5,000. So what is quorum? Quorum is a minimum number of members who must be present. Only that minimum number is present, only then we can say that the meeting is validly constituted. Only then we can commence the business in the meeting. What is this quorum number? In a private company, 2 members. In a public company, if the company has up to 1,000 members, then 5. If the company has more than 1,000 but up to 5,000 members, then 15. And more than 5,000 members, then 30. Okay, when you're counting quorum, now which member will you count? Which member will you not count? See, you will check, no, do I have 5 members or not? Do I have 15 members or not? You will count before you start the meeting, no, that do I have 5 members? Do I have 30 members? You will count. So when you're counting, whom and all will you include and whom and all will you exclude? You will include only those members who are personally present, which means proxies you will not consider. You will consider only those members who are personally present and who have the right to vote. You will consider only those members who are personally present and who have the right to vote. Will you count preference shareholders? You will not count preference shareholders. If your shareholder is a company, like for example, let us say my shareholder is a company, can the company personally come for the meeting? Impossible. So company will send one representative. Will I count that representative? Yes, company's representative I can count. But there's a possibility that the same person may be representing 5 companies. So in that case, I will count that one person as how many people? I will count him as 5 people. If that, see, first of all, I will count only those members who are personally present. I will not count proxies. I will not count preference shareholders. Then, if my shareholder is a company can't personally come. Company will send representative only. So, representative I will count. But if that same representative is representing multiple companies, how many companies he is representing? That many I will count. One person representing 5 companies. So, I will count him as 5 people have come. Then, if my shareholder is a president of our country or is a governor of our country, I can't expect these people to leave the country's work and come and sit in my meeting. So the president and the governor, even they will send representatives. Even those representatives I will count. So whom will I count? Whom will I not count? That is what this question is all about. Tell me, my company over here is X Private Limited. X Private Limited, private company. So what is a quorum? Quorum is 2, but the articles of association is saying 6. Is that allowed? Yes, articles of association can give a higher number. Articles of association can prescribe a larger number. But tell me, can the articles of association let you take up a lesser number? No, articles of association cannot relax the requirement. Articles of association can make it stricter. They can increase. So as per the law 2, as per AOA 6, so which number will you follow now? You will follow 6. AOA can make it stricter. Now listen, will we count all these people? Mr. G, representative of Governor of Gujarat, will we count him? Will we count the governor's representative? Yes, we can't expect the governor and the president to come. A and B, preference shareholders. Will we count preference shareholders? We will not count preference shareholders. Then Mr. L representing M, N and X. Mr. L, he's a representative of companies. Will I count him? Yes, but he's representing 3 companies. So I will count him as how many people? I will count him as 3 people. Then P, Q, R, S are proxies. Will I count the proxies? No. I will count only the members who are personally present. So how many people are present? Only 4 are present. But how much quorum do I need? I need 6. So do we have quorum? We have no quorum. So can we start the meeting? We can't start the meeting. Okay, only if the quorum is present, only then we can start the meeting. So in the last attempt, if you see, they had asked a question from a proxy in the meetings chapter. Okay, this time we prepared either notice or quorum. Notice or quorum, both important from the meetings chapter. Okay, so what was I telling you? Question number 12, quorum. Quorum you've understood, right? Private company, 2. Public company depends upon the number of members. Up to 1,000 members, 5. More than 1,000, up to 5,000, 15. And more than 5,000, 30. Okay, whom to include, whom to exclude? Preference shareholders? No. Proxies? No. Representative of companies? Yes. Representative of president, governor? Yes. All right, guys, I'll take you to the next question now. Question number 13. We are again coming back to other laws. Question number 13 is from your General Clauses Act. Okay, let us have a look at the question. Very simple question. There is a concept, right, that singular includes plural, plural includes singular. This question is about that. Have a look at the question. As per the provisions of the Companies Act 2013, a whole-time KMP shall not hold office in more than one company except its subsidiary company at the same time. Now, the law says whole-time KMP shall not hold office, shall not hold office in more than one company except its subsidiary company at the same time. Tell me, does one company include many companies? Can I say one includes two, two includes one? No. One means one only. But subsidiary company, this is singular or plural? This is singular. So I can say that it includes even plural. I can read it as subsidiary companies, right? If a number is given, one means one only. If a number is given, one means one only. But if number is not given, singular, subsidiary company, I will read it as subsidiary companies. Referring to section 13 of General Clauses Act, examine whether a whole-time KMP can be appointed in more than one subsidiary companies. Yes or no? Subsidiary company, can it be more than one also? Yes, it can. See, only one company, but that company is how many subsidiaries? Any number of subsidiaries. Because this is singular, singular will include plural. So, like for example, Reliance Industries Limited, TCS, Infosys. Okay, listen, okay. Reliance Industries Limited is a holding company. It has a subsidiary, Just Dial. It has a subsidiary, Urban Ladder. It has a subsidiary, Geo Telecommunications. Okay, now there is this one person Orange. Tell me, can this one person Orange be a KMP in Reliance, TCS and Infosys? No, you can be a KMP only in one company. Can he be in Reliance alone? Yes. Can he be in Reliance, Just Dial, both? Yes, because you can be in the company and the company subsidiary. Can he be in Reliance, Just Dial, Urban Ladder and Geo? Yes, because company and its subsidiaries. Can he be a KMP in Just Dial, Urban Ladder and Geo Telecommunications? Just tell me. No. No, right? Because three separate companies. If he is a KMP in Reliance, he can also be KMP in its subsidiaries. Subsidiary, I will read it as subsidiaries. Singular will include plural, plural will include singular, but one is one only. Perfect understanding? Yes, subsidiary, singular. I will read it as subsidiaries. That is this question from General Clauses Act. Okay, now let me take you to the next question. This next question again is from General Clauses Act only. I think I have 3 questions from General Clauses Act. Yeah, look at this question number 14. Let us read the question. Board of Directors of Agrawal Construction Private Limited authorized by passing a resolution in the board meeting Mr. Munim to appoint 5 employees for accounts department of the company. Did you understand what happened? There's a company, Agrawal Construction Private Limited. They, by a board resolution, they told Mr. Munim that you appoint 5 employees. So they have given power to Mr. Munim. What power have they given to Mr. Munim? What is the power that they have given? Power to do what? power to appoint. They have given a power to appoint. Okay. Now, what did he do now? Mr. Munim appointed 5 employees, including Mr. Rupal, who was relative of one of the director of the company. So he has appointed 5 people. After 1 month, Mr. Munim observed that Mr. Rupal was not performing his duties honestly. Mr. Munim issued the order of dismissal of Mr. Rupal with proper reasons. Mr. Rupal filed a petition in the court that his dismissal order is not valid, as board of directors had authorized Mr. Munim only for appointment of employees and not dismissal. Understanding the question, the board of directors told Mr. Munim, you can appoint employees. Mr. Munim appointed Mr. Rupal. Later, Mr. Munim did not like Rupal's work. So Mr. Munim is now dismissing Rupal. Rupal is telling Munim, you don't have the power to dismiss me. Board only gave you power to appoint employee. Board did not give you power to dismiss employee. Tell me what the directors is saying. Is it what Mr. Rupal is saying? Is it right? No. Power to appoint also includes the power to suspend, also includes the power to dismiss. If you have the power to appoint, it automatically also includes the power to suspend. It automatically also includes the power to dismiss. Understanding? Yes, power to appoint also automatically includes the power to suspend. It also automatically includes the power to dismiss. And one more extra point, power to appoint. Whenever you get a power to appoint, it is not necessary you have to appoint only by name. You can also appoint ex officio. Ex officio means what? By virtue of office. Like for example, for NAFRA, we need a chairperson. And this chairperson is going to be appointed by whom? This chairperson is going to be appointed by central government. So central government has a power to appoint. Now either central government can say that Mr. John, you are going to be the chairperson of NAFRA. Either central government can appoint by name, or central government can say that whoever is a secretary of Ministry of Finance, that person will automatically become chairperson of NAFRA. So when central government says that secretary of Ministry of Finance will become the chairperson of NAFRA, is central government appointing by name? No, central government is appointing by office, which means whoever is sitting in this office, that person will become the chairperson. This is called ex officio. Understanding? So ex officio means we are not appointing by name. Instead, we are appointing by office. Crystal clear? Yes, so this was our second question from the General Clauses Act. Our first learning from the General Clauses Act was that subsingular will include plural. The subsidiary will include subsidiaries. Our second learning was that power to appoint will automatically include power to remove, power to dismiss, power to suspend. Power to appoint, whenever you have the power to appoint, either you can appoint by name or you can also appoint by virtue of office. Okay, all right. This was question number 14. Perfect understanding until here. Can we proceed? Can we go to question number 15? So I'm taking you through question number 15 now. Okay, let me start the discussion. The question says, this question is about General Clauses Act again, and is about previous publication. Let me discuss the concept with you first. See, before the government makes rules, the government first of all publishes the rules for the information of the general public. Anybody in the public who has any advice, any suggestions, any objections, we can send our responses or our opinions to the government, to the specified authority within a date. The date will be mentioned in the draft itself. So they will first publish the draft rules, and they will ask us that if we have any advice, any opinions, we can send our opinions, and they'll also specify a date in the draft. On or before that date, we have to send our opinions. And then finally, they will publish the final rules in the official gazette. So which means they will end up publishing the rules twice. So before making the rules, the authority will publish a draft of the proposed rules for the information of the people who will likely get affected. Along with the draft, a notice will also be published along with the draft. In that notice, a date will be written, that on or before that date, you can send your objections or you can send your suggestions. And once all of this is done, the government will consider your objections, the government will consider your suggestions, and on that basis, the government will make the final draft, the final rules. The final rules will be made and the final rules will be published in the official gazette. So we will end up publishing the rules twice. First, we published the draft and then we will publish the final rules. So we will end up publishing twice. Now listen, once the final rules are published in the official gazette, it is presumed that the procedure for previous publication was duly followed and irregularities in the publication process cannot be questioned subsequently, which means, see, we published the draft first and then we have published the final rules. Okay, once we publish the final rules, after this, nobody can find faults in our draft publication. Once we publish the final rules, we will assume that all the rules and regulations relating to the previous publication, we will assume that all of those rules and regulations were properly fulfilled. Once we publish the final rules, if anybody finds irregularities in the publication of draft, please don't question us now, because we have already published the final rules. Now you cannot go back to the draft and question us. Okay, then listen. First, they had published the draft. Then they had published the final rules. Now, between the draft and the final rules, there will be some changes, guys. So, for those changes, do they have to republish the draft once again? Do they have to ask for opinions and suggestions again and again? No, the authority has the power that after submitting the draft, after publishing the draft, before they make the final rules, in the final rules, they can make suitable changes and they can straight away publish the final rules. They don't have to republish the draft of the final rules once again. You're understanding? So first of all, they will publish the draft, then they will publish the final rules. Between the draft and the final rules, obviously, they will make some changes. This final rule will not be copy-paste of this draft. There will be suitable changes because you had sent so many objections, you had sent so many suggestions. Government is going to consider that and the government will incorporate your objections and your suggestions and the government will make the final rules. So the final rules, yes, definitely it will have some changes from the draft rules, but we don't have to republish the draft. We don't have to republish the amended rules and ask your permission. That is not required. Okay, so keep this in your mind and look at this question. This question was a May 2022 4 marks question. According to me, it's a very good question from the examination point of view with regard to this concept of previous publication. Okay, listen, the question says, the Ministry of Corporate Affairs published in the Gazette of India the proposed draft of rules further to amend certain rules under the Companies Act. So they have published draft of rules. MCA made some modifications in the draft rules already published. Is that allowed, guys? Between the draft rules and the final rules, can there be changes? Yes, of course there will be suitable changes. But is it required to republish the amended draft? No, that is not required. If the changes are not very, very significant, they can straight away make the final publication itself. In the light of the provisions answered, is it required for MCA to publish a draft of the proposed rules? Tell me, do they have to publish the draft of the amended rules once again? No, they have already published the first draft. The first draft rules they have already published. Now they can straight away publish the final rules. They can straight away publish. Then, in case of irregularities in the publication of the draft, can it be questioned? Tell me, once the final rules are published, can we question the draft now? No. Once the final rules are published, can we find irregularities in the draft now? No. Once the final rules are published, we will assume that the draft and all was properly published. Then third point, is MCA entitled to make suitable changes in the draft? Can they make changes in the draft? Between the draft and the final rules, can there be changes? Yes, suitable changes will be there. Is it necessary to republish the rules in the amended form? Do you have to republish the rules in the amended form? Not required. You have already published the draft. You can straight away publish the final rules. You don't have to republish the amended rules. That is not at all required. Understanding, this is question number 15 for you. All right, guys. Yes, so giving this is important and therefore I want to summarize it for you one last time. The government, what they do is whenever they publish rules, they first publish the draft. They first publish the draft rules. Along with the draft rules itself, they will also give a notice also. That notice will contain a date. That on or before that date, you can send your suggestions, you can send your objections. Once the government sees your suggestions and objections, the government will republish the final rules. Between the draft and the final rules, there will be changes, obviously. All right, but the government does not have to republish the amended rules for your information and all. They can directly publish the final rules. And one more point we had learned, once the final rules are published, same thing was there in the second point also. Once the final rules are published, can we question the irregularities in the publication of the draft? Once the final rules are published, we cannot question the draft anymore. There might have been some mistakes which the government would have done in publishing the draft rules, but we can't question that anymore. Why? Because now final rules have been published. Once the final rules are published, we will assume that all the points, all the concepts, all the rules and regulations relating the draft point, we will assume that all the rules and regulations relating to previous publication, everything has been fulfilled, we will assume. Okay, guys, understood, right? This was question number 15. Now coming to question number 16. Question number 16 is a question from the dividends chapter. Okay, let's have a look at the question. The question says, Mars Limited declared and paid dividend in time to all its equity holders for the financial year 16-17, except in the following two cases. Mrs. Sheetal, holding 250 shares, had mandated the company to directly deposit the dividend amount in her bank account. Company accordingly remitted the dividend, but the bank returned the payment on the ground that there was difference in the surname of the payee in the bank records. The company, however, did not inform Mrs. Sheetal about the discrepancy. What do you think? See, there's a company, Mars Limited. They have declared dividend. There is one particular shareholder, Mrs. Sheetal. She has given instructions to the company. She has mandated. Mandated means what? Mandated means she has given instructions to the company. She has instructed the company. What instruction has she given to the company? That company, whenever you declare dividend, you deposit the dividend in my bank account. These are my bank account details. So accordingly, the company tried to remit the dividend to that particular bank account. But when the company tried to remit the dividend to that particular bank account, the bank returned the money saying that there is a difference in the surname. Which means what? Which means that Sheetal had given wrong bank account details. Sheetal had given wrong bank account details, because of which we were not able to follow her instructions. Because we were not able to follow her instructions, we were not able to remit dividend to her. And the company did not inform Mrs. Sheetal about this. Tell me, is the company liable? Does the company have any liability over here? Can we punish the company? Yes, company, you are liable, because company, listen, in case the shareholder has given you directions for payment of dividend, and if those directions cannot be complied with, you have to inform the shareholder. Once you inform the shareholder, then you will not have any liability. Then you can escape. But if you don't inform the shareholder, then you are going to be severely punished. And what will the punishment be, guys? What will be the punishment if the company does not pay the dividend within 30 days from declaration, or if the company does not post the dividend warrant within 30 days from declaration? What is the punishment? The directors will also be punished. The company also will be punished. Company will be punished with 18% per annum interest. Directors will be punished with imprisonment 2 years maximum, imprisonment and 1,000 per day fine. Severe punishment. This is a very, very important punishment, something which you can't forget. All right, guys. So listen, company, in case a shareholder, come on, let's summarize. Listen, company, in case a shareholder has given you some directions, and if you're not able to follow those directions, what should you do, company? You must inform the shareholder about it. If you inform the shareholder about it, you will not be liable, you will not be punished. But if you don't inform the shareholder, you will also be punished. 18% per annum interest. Your directors will also be punished. Your directors will be punished with imprisonment maximum 2 years, and with fine. Fine how much? 1,000 rupees per day fine you will be punished. Understood first concept, everybody? Yes. Then listen to the second situation. Dividend amount of 50,000 was not paid to Mr. Piyush, deceased, in view of the court order restraining the payment due to family dispute about succession. Here, tell me, the company could not pay the dividend because some dispute was going on in the court. Will we punish the company for this? Is the company liable? No, company, you are not liable. Which point is this? If there's a dispute regarding the right to receive dividend, if there is a dispute regarding right to receive dividend, in such cases and all, the company is not going to be held liable. Okay, guys, this was question number 16 about payment of dividend. All right, so 2 points we have seen over here. In fact, 3 points we have seen. Point number 1, if the shareholder has given instructions and if we are not able to follow those instructions, then we have to inform the shareholder about it. Once we inform, we will not be punished. Second, we have learned that if there's any dispute going on and because of the dispute, if we were not able to pay the dividend, even there we will not be punished. And thirdly, if we don't pay dividend within 30 days from the date of declaration, or if we don't post a dividend warrant within 30 days of declaration, then company will be punished with 18% per annum interest, and even the directors will be punished with imprisonment maximum 2 years and fine of 1,000 rupees per day of delay. That was question number 16 from dividends chapter. Now, from the dividends chapter, there is one more question which we will see a little later. One computation question I have brought in. We will see that later. Come to question number 17. Question number 17 is again from General Clauses Act and Interpretation of Statutes from that chapter. Look at the question. The question says, Ayush and Vipul are good friends and they're pursuing the CA course. While doing group studies for the paper for corporate and other law, they are confused about the provision of Section 3 of the Companies Act. Section 3 provides a company may be formed for any lawful purpose. Company may be formed for any lawful purpose. Both Ayush and Vipul are in difficulty about the meaning of the word may, whether it should be taken as mandatory or whether it should be taken as directory. Now listen. Generally, what does the word may mean then generally? Generally, may is directory. And generally, what is shall? Generally, shall is mandatory. And what is the word must? Must is always mandatory. Must is a command. Must is always mandatory. See, must will always be mandatory. This will never change. But in some cases, even though we have the word may, we will read it as if it is shall. And in some cases, even though we have the word shall, we will read it as if it is may. You know it, guys. So what are those situations when may will be read as shall? What are the situations where may will be read as shall? If there is a discretion in along with an obligation, which means there's an obligation which indicates the provision has the word may, but the provision is saying that if you don't fulfill this provision, there will be a penalty. So there is the word may is there, which means discretion. But if you don't fulfill this provision, there is a penalty. So obviously, it's going to be mandatory, guys. You will read it as if it is shall. Then number 2, if that particular provision confers a positive benefit. If that particular provision confers a positive benefit, which means if that provision is for the benefit of the society, or where the remedy would be advanced and the mischief would be suppressed. Where a remedy would be advanced and mischief would be suppressed. What is this? If giving the word may, shall meaning, if I give the word may, shall meaning, if I give the word may, mandatory meaning. By doing that, if I'm able to advance the remedy and suppress the mischief, then also, even though it is a word may, I will read it as if it is shall. And number 4, if I read the word may as directory, okay, if I read it as directory, because of doing that, if the object of the statute is going to get defeated, I might as well read it as shall. So this is the rule of exceptional construction. The rule of exceptional construction says many points. Like for example, first of all, it says that and is conjunctive or is disjunctive. But if the intention of the lawmaker is otherwise, I can read the word and as or as and also. Then similarly, it says that generally may is directory and shall is mandatory. But in some exceptional cases, I can read them vice versa also. In some exceptional cases, even though I've written the word may, I will read it as shall. I've written the word shall, I will read it as may. So what are the 4 cases where the word may will be read as shall? Number 1, if it is a discretion coupled with an obligation. Number 2, if it confers a positive benefit. Number 3, if giving the word may a mandatory meaning, if that is going to suppress the mischief and advance a remedy. And number 4, if giving the word may a directory meaning, if that is going to defeat the intention of the lawmaker, I might as well read it as if it is shall. Now, coming to this question, tell me, over here, should I read this word may as may or should I read it as shall? Should I give this word may mandatory force or should I give it directory force? In this case, I must give it mandatory force. I must read it as shall. Why, guys? Is it a discretion along with the obligation? No. Is it conferring a positive benefit? Is it giving any benefit? No. Remedy mischief? No. Which point? Intention of the lawmaker. Tell me, can the lawmaker's intention be that if you want you form company for lawful purpose, otherwise you form for unlawful purpose? Can that even be the intention of the lawmaker? No. So if I give the word may directory meaning, it will defeat the intention of the lawmaker. That is why I will give the word may over here a mandatory meaning. Understood, everybody? Does it make sense to you? Yes, even though it is a word may, I will give it a direct. I will give it a mandatory meaning over here in this question. Okay, because the law cannot have an objective of allowing people to make companies for unlawful purpose. So over here, I will say that the word may is used just for the sake of courtesy. Just for the sake of being polite, they're using the word may, but actually the word may over here has mandatory meaning. Okay, that was question number 17 for you, which was regarding may and shall. Now coming to question number 18. Question number 18 is a question regarding one-person company. Before I go into the question, I want to give you a small revision of some concepts involved in the question. See, one-person company, Section 8 company, listed unlisted companies, and holding subsidiary companies. 4 concepts I said. One-person company, Section 8 company, listed and unlisted company, and holding subsidiary company. From these 4, any one question at least will definitely come in your examination. This is a trend which has been noticed in 99% of the examinations. Out of these 4, at least one is generally tested. This question in front of you is regarding one-person company. See, listen now. Who can be a member and who can be a nominee? A minor cannot be member, cannot be nominee. Only a natural person can be a member, can be a nominee. An artificial person cannot be a member, cannot be a nominee. Member, nominee both have to be Indian citizens only. At a time, I can be a member only in one OPC. At a time, I can be a nominee only in one OPC. At the same time, I can be a member here, I can be a nominee here. But here where I am a nominee, there if the member dies, I will end up becoming a member. I am already a member here, I will also end up becoming a member here. Am I allowed to be a member in 2 OPCs at the same time? No, I am not allowed. So out of the 2 OPCs, I'll have to choose one. Within how many days will I have to choose one? Within 180 days, I'll have to choose one. And then, can a one-person company be converted into a Section 8 company? It can never be converted into a Section 8 company. But it can be converted into public company or private company anytime. Earlier, there was a rule that we have to wait for 2 years, only then we can convert. No such rule anymore. We can convert into public or private at any time. At any time, we can convert. A Section 8 company can never do NBFC activity. A Section 8 company cannot do any investment activity. Tell me, one-person company and Reliance. Tell me, can one-person company be a shareholder of Reliance? No, because one-person company cannot invest in other companies. Can Reliance be a shareholder of one-person company? No, because a member of one-person company has to be only a natural person. So neither can one-person company be a shareholder of Reliance, nor can Reliance be a shareholder of one-person company. Come on, guys, tell me, are you all understanding? Are you all following this discussion? Yes, guys, is this crystal clear? One-person company cannot be a shareholder of Reliance because one-person company cannot invest in other companies. Reliance can't be a shareholder in one-person company because in one-person company only one member is there, and that one member has to be only a natural person. Keep all of these points in your mind and look at this question now. Mr. Aditya had incorporated a one-person company on 7th July 2021. Mr. Yash was nominated as a nominee in the memorandum of the said one-person company. Tell me, is it necessary that the member and the nominee, they have to be related? Is it necessary that the member and the nominee have to be related? No, guys, not necessary. Blood relation, no, not necessary. Now, Mr. Aditya, considering the perpetual nature of company form of business, desires to appoint ABC Private Limited as a nominee. Tell me, can a company be a nominee? No, Mr. Aditya. Only natural person can be nominee. Only natural person can be member. This is not allowed. So therefore, it is not allowed. But the reason why I have brought this question was not because this question is important, but because whatever concept I have discussed with you over here, this is important. So be thorough with this entire chart over here. Anything from this chart can be there in your examination, either in the form of an MCQ question or in the form of a descriptive question. Okay, then coming to question number 19. Question number 19 is a question from holding subsidiary company. Before I discuss that question with you, let me discuss the concept once quickly. See, listen. When do you say that holding subsidiary relationship is existing between two companies? If one company is controlling the composition of board of directors, one company is controlling the composition of board of directors, which means if I have the power to appoint your directors, or if I have the power to remove your directors, if I have the power to appoint majority of your directors, or if I have the power to remove majority of your directors, I am controlling your board of directors. I will become the holding company, you will become the subsidiary company. First method. Second method, if I control more than half of your total voting power, don't use the 50% number, don't use the 51% number, use the fraction over here. If one company controls more than half, if one company controls more than half of the total voting power of the other company on its own or through subsidiaries. And number 3, subsidiary. The chain holding subsidiary will also become the holding company subsidiary. So how is holding subsidiary relationship formed? Holding subsidiary relationship is formed in totally 3 methods. Number 1, when one company controls the composition of board of directors of the other company, which means I am controlling, I can appoint majority of your directors, or I can remove majority of your directors. That is when you will say that I have become your holding company. Second, if I control more than half of your total voting power, either on my own or along with my subsidiaries. And number 3, subsidiary. This is how does holding subsidiary relationship get formed. When we are checking more than half of the total voting power, we will not count shares which are held in fiduciary capacity. Shares which I'm holding just as a trustee, shares which I'm holding just in fiduciary capacity will not be considered. Listen now, the next part. Can a subsidiary company hold shares in holding company? See, holding company controls the subsidiary company, right? Can subsidiary company hold shares in the holding company? Generally, the answer is no. Subsidiary company cannot hold shares in the holding company. But there are 3 exceptional cases. Subsidiary company can hold shares in the form of a legal representative. Subsidiary company can hold shares in the position of a trustee. And even before holding subsidiary relationship was formed, even before that, if the subsidiary company was already having shares of the holding company, subsidiary company can continue to hold those shares. This is the concept involved. Okay. And one more thing, if the subsidiary company is holding shares as a legal representative or as a trustee, then the subsidiary company will have voting rights in the holding company. But if subsidiary company is holding shares in the holding company, shares which subsidiary company had even before the holding subsidiary relationship was formed, for those old shares and all, I will not give voting right. For old shares, no voting rights. For shares being held as legal representative, for shares being held as a trustee, for those shares, I will give you voting right. Okay, now look at this question. This is slightly a tricky question. So therefore, we will draw a diagram to understand this question better. Okay, listen. What does the question say? The question says AB Limited issued equity shares of rupees 1 lakh, 10,000 shares of 10 rupees each on 1st April 2020, which have been fully subscribed, whereby XY Limited holds 4,000 shares and PQ Limited holds 2,000 shares in AB Limited. So listen, there is one company, AB Limited. This AB Limited has totally how many shares, guys? They have totally 10,000 shares. Out of these 10,000 shares, if you see, the question says XY Limited holds 4,000 shares, right? And PQ Limited holds 2,000 shares. So what about the balance 4,000 shares? The balance 4,000 shares, probably some other people hold it. AB Limited is also holding 20% shares of RS Limited. So there is one more company called RS Limited. The question says AB Limited is holding 20% shares of RS Limited. So in RS Limited, AB Limited is a shareholder. AB Limited is holding 20% of the shares of RS Limited. Then the question says, before the date of issue of equity shares stated above, RS Limited controls the composition of board of directors of XY Limited and PQ Limited. Which means what? RS Limited controls the composition of board of directors of XY Limited and PQ Limited, means RS Limited is the holding company. And who is RS Limited's subsidiary company? Subsidiary company is XY Limited and PQ Limited. How did the holding subsidiary relationship get created over here? RS Limited is controlling the composition of board of directors of XY Limited and PQ Limited. So XY Limited and PQ Limited will become subsidiary company and RS Limited will become holding company. This is the situation over here. Now, what are they asking us? Whether AB Limited is a subsidiary of RS Limited. They're asking us about AB Limited and RS Limited. Is AB Limited a subsidiary of RS Limited? Yes or no? See, listen. How does a company, I'll tell you how to answer these kind of questions in an easy manner. I have drawn my diagram. That itself has given me half the clarity. Now, they're asking me, is AB Limited, is it a subsidiary of RS Limited or not? They're asking me. Listen, I will think in this direction. I will think, how is holding subsidiary relationship created? How is holding subsidiary relationship created? Tell me, there are how many methods in which holding subsidiary relationship is created? There are 3 methods in which holding subsidiary relationship is created, guys. What are the 3 methods? When one company controls the composition of board of directors of the other company. Tell me over here, is RS Limited controlling AB Limited's board of directors? No. What's the second method? When one company controls more than half of the total voting power of the other company, either on its own or through subsidiaries. So in AB Limited, tell me, what is half of the number of shares? Half of the number of shares is how much? 5,000. Now tell me, in AB Limited, is RS Limited plus RS Limited subsidiaries put together, are they holding more than 5,000 shares? See, is RS Limited holding even 1 share? No. Subsidiaries XY and PQ are subsidiaries. So XY and PQ put together are holding 6,000 shares. Total 6,000 shares, which is more than 5,000 shares. So I can say RS Limited has become holding company and AB Limited has become subsidiary company. Yes, guys, which point is this? Which concept is this? Which point exactly is it? Holding company controls more than half of the total voting power with subsidiaries. If you notice, RS Limited is not holding even 1 share in AB Limited. Still, RS Limited, because of its subsidiaries, through its subsidiaries, RS Limited has become holding company and AB Limited has become subsidiary company. This was my first question. Then, after this, what else are they asking? They are asking us whether AB Limited can hold shares of RS Limited. Tell me, AB Limited is subsidiary company. RS Limited is holding company. So, can AB Limited hold shares in RS Limited? Now, freshly, can AB Limited buy shares in RS Limited? No. That will not be allowed because subsidiary company cannot buy shares in the holding company. But guys, even before all this, already in RS Limited, 20% of RS Limited shares are held by AB Limited. These shares can AB Limited continue to hold? Can these shares AB Limited continue to hold these shares? Will that be okay? Will that be okay? Yes. Now see, you might wonder, 20%, is any concept coming to your mind? Associate company concept is coming to your mind because RS Limited, AB Limited is having 20% shares of RS Limited. Significant influence. Who is saying substantial interest? No, Durga, you can't use the word substantial interest. Substantial interest is a 20% substantial interest is income tax concept. Here we use the word significant influence. Okay, so can I talk about or should I talk about significant influence concept here? No. When will I see? I am going to just answer whatever questions they are asking us. They are asking us whether AB Limited is a subsidiary of RS Limited. Yes, AB Limited is a subsidiary of RS Limited. Then they are asking us, can AB Limited hold shares in RS Limited? Freshly, AB Limited cannot buy shares in RS Limited. If RS Limited is now going to allot shares in AB Limited, it is going to be void. But shares which AB Limited was already holding in RS Limited, AB Limited can continue to hold. You're understanding, but I am not going to talk about associate company because is the question even targeting associate company concept here? No. So why unnecessarily waste time? Then whether AB Limited can vote at AGM of RS Limited. Tell me, for these shares, AB Limited is holding shares in RS Limited. What these 20% shares? Can I call them old shares? I can call them old shares, no? Because even before all this relationship was created, even before that AB Limited had bought the shares in RS Limited, tell me, for old shares, will I give AB Limited voting right? No voting right. Then no voting right. Understanding. Yes, so this was our discussion regarding this particular question. We are just going to answer whatever three questions they have asked us. Whether AB Limited is a subsidiary? Yes, it is a subsidiary. Why? RS Limited is not controlling the directors of AB Limited, but RS Limited plus RS Limited subsidiaries put together, they are holding more than half of the total voting power of AB Limited. More than 5,000 shares, 6,000 shares they are having. So yes, RS Limited, you are holding company. Yes, AB Limited, you are subsidiary company. Then they're asking us that, whether AB Limited can get shares in RS Limited. See, once a holding subsidiary relationship is formed, after that, the holding company should not allot shares in, should not allot its shares to subsidiary company. If it allots, it will become void ab initio. But shares which AB Limited was holding even before the holding subsidiary relationship was formed, the old shares AB Limited can continue to hold. But on these shares, sorry, I will not give you voting right. Now, if they were to ask us, who is associate company of whom, what would you say? Who is associate company of whom? RS Limited is associate company of AB Limited, or AB Limited is associate company of RB Limited, RS Limited. Who is the associate company of whom? RS Limited would become the associate company of AB Limited. But tell me, can RS Limited control AB Limited and AB Limited control RS Limited? Is that even possible? Can RS control AB and then AB control RS? No. So RS Limited will become holding company of AB Limited. There is no associate relationship. We will not talk about associate relationship because one company can't control the other and the other company again controlling that other company. It will keep becoming one circle only. So holding subsidiary, that relationship is more powerful than associate relationship. So if RS Limited is holding company of AB Limited, AB Limited cannot become AB Limited cannot say that RS Limited, you are my associate. So therefore, we will focus only on the holding subsidiary relationship because holding subsidiary relationship is more powerful than the associate relationship. This is question number 19, all about holding subsidiary companies. Okay, now come to question number 20. Question number 20 is a question regarding promoters. So who is a promoter? Who is a promoter? Look at the definition of promoter. The Companies Act defines promoters. For the very first time, Companies Act 2013 defined a promoter. The definition is given in three parts. Number one, it says that the promoter's name is written where? It is written in the prospectus also, written in the annual return also. In the prospectus also, written in the annual return also. Then second, the definition says that the promoter, somehow he controls the company, either directly or indirectly. Either he will become a shareholder and control, or he will become a director and control, or in some other form, but he will have some control over the company. And finally, the board of directors is accustomed to act according to his advice and directions. Whatever advice and directions he gives, the board of directors is accustomed to act according to that. So who is a promoter? 3 points totally. Number one, where is his name written? His name is written in the prospectus and also it is written in the annual return. Number two, he controls a company directly or indirectly, either as a shareholder or as a director or in any other form, he controls a company. And number three, the board of directors is accustomed to act according to his advice and directions. Whenever the board of directors need any advice or directions, they always look up to the promoters. So this is the definition of promoters. But tell me, can a company be a promoter of another company? Yes, it is not necessary that the promoter has to be only a natural person. Even a legal person can be promoter. Can the same company have multiple promoters? Yes, we can have any number of promoters. We can have more than one promoter also. Then a person acting merely in professional capacity will not be considered as promoter. I want to incorporate the company. I don't know how to incorporate the company. I go to one company secretary. I take the company secretary's help to incorporate the company. Tell me, don't you think the company secretary is now a part of the incorporation process? So just because the company secretary is a part of the incorporation process, can we say that company secretary is also promoter now? Because even he is helping in the incorporation process? No. Company secretary is only rendering professional service to me. So person rendering professional services and all is not a promoter. This is a concept involved. Now have a look at the question. Mr. X, a chartered accountant and an MBA by profession. He has been appointed as an executive director on the board of ABC Limited. His job profile includes advising the board of directors of the company on various compliance matters, strategies, business plans, and risk matters relating to the company. Keeping in view the above position, whether Mr. X can be classified as promoter of ABC Limited. Can we call Mr. X as a promoter? He is a chartered accountant. He's an MBA. He is appointed as an executive director, which means he's appointed as an employee. He's only going to advise the board. He's going to give only professional services to the board. He's going to advise the board on compliance matters, on strategies, business plans, risk matters and all. How will he become promoter? He is not a promoter. He is only rendering services in his professional capacity. He is not going to become a promoter. This was question number 20 regarding promoters. Now come to question number 21. Question number 21 in front of you is a question, a very interesting question. This was an RTP May 2022 question, okay? This one question touches upon holding subsidiary company concept. It touches upon the public company concept. It touches upon limited and unlimited companies. Listed and unlisted companies. It covers that also. So this one question itself, you have to make sure you see this question before the examination, guys. It's a very, very important question. It will give you a revision of multiple concepts. Okay, now look at this. There's a company, K Limited. It has listed non-convertible redeemable preference shares issued on a private placement basis in terms of relevant SEBI regulations. Listen, K Limited, what kind of a company? K Limited, public company, guys. This public company has listed something. Immediately what comes to my mind? Immediately, listed company comes to my mind because you have listed some security. But what did you list? You listed non-convertible redeemable preference shares. That too on private placement basis. So will I consider you as listed company? Will I consider you as listed company? No, I will not consider you as listed company. Listen, all those public companies which have not listed equity shares but have listed non-convertible debentures. They have not listed equity shares but they have listed non-convertible preference shares. They have not listed equity shares but they have listed both non-convertible debentures also, non-convertible preference shares also. Or private companies which have not listed equity shares but have listed non-convertible debentures, and public companies whose securities are listed not in recognized stock exchange in India. Instead, public companies whose securities are listed in some foreign stock exchange outside India. These companies are not listed companies, which means these companies are unlisted companies. Once again, guys, a little patiently, please. You're a public company. You have not listed equity shares. You have listed non-convertible debentures issued on a private placement basis. Even though you have listed something, I will treat you as unlisted company. You're a public company. You did not list equity shares, but you listed non-convertible preference shares, which you issued on private placement basis. Something you have listed, but still I will consider you as unlisted company. You are a public company. You did not list equity shares, but you listed both non-convertible debentures also, non-convertible preference shares also, which you had issued on private placement basis. Something you have listed, but I will still treat you as unlisted company. You're a private company. Private company, you have listed non-convertible debentures you have listed, which you had issued on private placement basis. Something you have listed, but still I will consider you as unlisted company. You're a public company. You did not list your equity shares in Bombay Stock Exchange, National Stock Exchange and all. You did not list. But instead, you went to New York Stock Exchange. To one foreign stock exchange, you have gone and listed. In India, you did not list. You went and listed in some foreign stock exchange. I will consider you as unlisted company, because when do I call you as listed company? Only if your securities are listed in India's recognized stock exchange. Okay, now with this knowledge in your mind, come to this point again. It's a public company. It did not list equity shares. It has listed non-convertible preference shares issued on a private placement basis. Something listed, but I will still treat it as unlisted company. Right, guys? So do you agree, first of all, K Limited is a public company. It's an unlisted company. It has the power to appoint 2/3 of the directors in I Limited. So which means, do you agree that K Limited can appoint more than half? 2/3 is more than half, guys. So do you agree that K Limited can appoint more than half of the directors of I Limited? So which means, do you agree that K Limited controls the composition of board of directors of I Limited? So which means, do you agree that K Limited is a holding company of I Limited? Agreed? Yes. Now listen to the second point. I Limited. Name itself tells you what kind of a company. This is going to be a public company. It has not listed equity shares, guys. It has listed non-convertible debentures issued on a private placement basis. Yes, you listed something, but you listed non-convertible debentures. So even though you listed something, I will treat you as unlisted company. And this I Limited has 60% voting power in S Private Limited, which means I can say that I Limited controls more than half of the total voting power of S Private Limited, which means I can say that I Limited is holding company of S Private Limited. I can also say that a private company, which is a subsidiary of a public company, is what now? How do you treat this company now? You will treat this company as a deemed public company. It's actually a private company, but it is a subsidiary of a public company. So I will treat it as if it is a public company, deemed public company. So then S Private Limited, private company, but I will treat it as a public company. It has listed non-convertible debentures. Something you have listed, but you've listed non-convertible debentures issued on a private placement basis. I will treat you as if you are an unlisted company. This company holds 52% equity shares in P Limited. Guys, 52%, which means what? Which means more than 50%, more than half. This company has more than half of total voting power of P Limited, but on behalf of another company, only as a trustee. Tell me, when you're checking holding subsidiary relationship, do you count shares held in fiduciary capacity? Do you count shares held as a trustee? No. So S Private Limited is not a holding company of P Limited. Understanding, everybody? Yes, S Private Limited, yes, they are holding more than half of the total voting power of P Limited. They're holding, but they're holding only in fiduciary capacity. Remember, we had over here shares held in fiduciary capacity will not be counted. As a trustee is nothing but fiduciary capacity. So no S Private Limited, you are not holding company of Pratibodh Limited. Now listen, the question says whether the aforesaid companies can be considered as listed companies. Tell me, once we've done this analysis, anything they ask us here, we will be able to answer. Can I call these companies as listed companies? Unlisted, 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 all of them are unlisted companies. Explain the relationship between the companies. This easily we can say. K Limited is holding company of I Limited because K Limited controls composition of board of directors of I Limited. I Limited is holding company of S Private Limited because I Limited controls more than half of the total voting power of S Private Limited. Because S Private Limited is a private company, which is a subsidiary of a public company, even though it is a private company, I will treat it as if it is a public company. Finally, S Private Limited, yes, they have more than half of the shares of P Limited, but only in fiduciary capacity, only as a trustee, and therefore I will not consider it as holding subsidiary relationship. Understood, guys? A very interesting question. This question might have been an eye-opener for many of you. Can I take you forward? Can I take you forward to the next discussion? Going to the next question now, going to question number 22. Let me give it a reading first. This question is regarding service of documents. This question is all about service of documents, a very simple concept actually. Whenever an outsider or ROC or anybody, okay, if anybody wants to send anything to the company, or if we want to send anything to a director of the company, first of all, tell me to which address will we send? To which address will we send? We will send it to the registered office address, guys. We will send it to the registered office address, but in what mode will we send? We have 5 options. We can send by registered post, we can send by speed post, we can send by courier, we can go personally and leave it at the registered office, or we can send it by email. Law itself is giving us 5 options. When law itself is giving me 5 options, tell me, can the company say that no, send me only by courier? No chance. Law itself is giving me 5 options. So, company, how can you put restrictions on me? So, if anybody, ROC, me, outsider, shareholder, anybody wants to send anything to the company or to the director, first of all, we will send it to the registered office address. And in what mode will we send? We have 5 options. We can send it by registered post, we can send it by speed post, we can send it by courier, we can leave it at the registered office, or we can send it by email. This is a concept over here. Now have a look at the question. Articles of Association of PQR Limited provided that documents upon the company may be served only through email. Tell me, is this allowed? The company's AOA is saying, if you want to send anything to the company, only send by email. This is not allowed like that. See, listen. Can shareholder tell the company, if you are sending me anything, send me only by courier? Can shareholder tell the company? Yes. And shareholder will also deposit one amount with the company. That company, use this money, send me whatever you are sending me only by courier or only by speed post. Shareholder can tell the company. Can company tell the whole world? No. When we have to send anything to the company, we have 5 options. Company cannot take away that right from us. Company cannot say send only through email. No, this is not right. Arvind sent the document to the company by registered post. Did Arvind do anything wrong? No, registered post is allowed. Company did not accept the document on the ground that sending documents to the company by post was in violation of the articles. As a result, Arvind suffered loss. Decide validity of the argument of the company. Is the company right? Company saying you should have sent only by email. AOA, clearly it is written that you should send only by email. Why did you send by registered post? Can the company say that? No, company cannot, because the law itself is giving us 5 options. We can send to the company by 5 methods to its registered office. Here, company has made a fault. Company has made a mistake by not accepting my registered post. So therefore, whatever loss Arvind has suffered because of this, who will bear this loss, guys? The company only will have to bear this loss. The company will have to pay damages for reimbursing the loss suffered by Arvind. Simple concept. This was about service of documents, section number 20. Okay, coming to question number 23. Oh, this is a very important question from the prospectus chapter. Okay, now in prospectus, you have learned about misstatement in the prospectus. You have learned about civil liability, criminal liability and all, right? Now I'm talking about civil liability. This question is focusing only on civil liability. Come to the provision first. What does a provision say? By the way, civil liability section number you should remember. You should definitely remember. What is the section number of civil liability? Criminal liability is 34. Civil liability section 35. Now, what does civil liability concept say? See, first of all, 5 people. 5 people will have civil liability. Who are the 5 people? Number 1, in fact, 6 people. 6 people, company and 5 people. So totally 6 people will have liability, civil liability. Who are these 6 people? Number 1, the company. Number 2, director of the company. Number 3, a person who is actually not director, but is authorizing the company. Put my name also as director. Then promoter of the company. Then every person who has authorized the issue of prospectus and expert. Totally 6 people. Number 1, director of the company. Number 2, a person who is authorizing the company, that yes, put my name also as director. Number 3, promoter of the company. Generally, the second point is for those companies which are, now only they're going to come into existence. New companies which are in the process of incorporation. Generally, the second point is applicable to those companies. Anyways, coming back. So, director of the company, then every person who is authorizing himself to be named in the prospectus as director, promoter of the company, persons who authorize the issue of prospectus, expert and company. These 6 people will have civil liability. They will be liable to whom? They will be liable to all those persons, listen carefully, they will be liable to all those persons who subscribe to the securities of the company, they will be liable to all those persons who subscribed. Keyword subscribed. You should not use the word purchased. You have to use the word subscribed over here, because subscribed means what? You directly filled share application form. You gave the share application form to the company. Company accepted your share application form. Company allotted shares to you. So directly you have purchased from the company. Directly you got the shares from the company. That is why you should use the word subscribed. Okay. Purchased means what? Purchased means what? Purchased means you went to the market and you bought it from the market from some other shareholder. Here, we are not talking about purchase cases. If you go to the stock exchange and if you buy from the stock exchange, there you will not apply civil liability concept. You will apply civil liability concept only if I directly purchased it in the IPO from the company. I directly purchased it from the company as an allotment, new shares, fresh shares in the public offer, new shares company has directly allotted to me. That is what we're talking about over here. So 6 people, okay, with 6 people, director, person who authorizes himself to be named in the prospectus as director, then promoter of the company, then every person who authorizes the company to issue the prospectus, number 5 expert, and number 6 company. These 6 people, they are liable to all the persons who relied on the prospectus. Which prospectus? Misleading prospectus. So all the persons who relied on the company's misleading prospectus and subscribed to the company's shares and as a result suffered a loss. For that loss, these 6 people are going to be having civil liability. So they will have liability towards whom? They will have liability towards those persons who relied upon the company's misleading prospectus. On the basis of that misleading prospectus, they subscribed to the company's securities and as a result, they suffered a loss. So for that loss, these 6 people will be liable. Relating to this, we also have the case of Peak versus Gurney. Very important case law. Peak versus Gurney. Here what happened is Gurney issued a fraudulent prospectus on behalf of a company. So there was a misleading prospectus issued by Gurney. Peak did not purchase the shares at that time. Later, Peak purchased 2,000 shares of the company from the stock exchange. Now tell me, can Peak say that I want civil liability, I want to sue on civil liability? Can Peak sue the company? Can Peak sue the directors under civil liability? No, Mr. Peak, you did not buy directly from the company. You did not subscribe to the shares. You only purchased the shares from the stock exchange. You did not subscribe to the shares. So this entire discussion over here, which is the word we are stressing upon, we are stressing upon the word subscribed. Keep this concept in your mind. Look at this question. Peak Limited issued and published its prospectus to invite investors to purchase its shares. Prospectus contained false statement. Mr. X purchased some partly paid shares of the company in good faith on the stock exchange. Subsequently, the company was wound up and the name of Mr. X was in the list of contributories. Can Mr. X sue directors of the company to recover damages? Can Mr. X sue the directors of the company? Can Mr. X claim any action under Section 35 civil liability? No, Mr. X, you did not subscribe to the company's shares. What did you do? You purchased. You purchased from the stock exchange. You did not subscribe to the company's shares. So even if there is misstatement, sorry, Mr. X, you will not have any civil liability action at all. You cannot take any action under Section 35 at all. 100% clear. Yes, but tell me, do we have all these concepts even in criminal liability? No, because in criminal liability, anyways, what happens is the shareholder is not taking action against a company. In criminal liability, it is a state that is taking action against a company. So criminal liability, the only precondition in criminal liability is that there must be mens rea. Mens rea means what? Mens rea means purposely you must have put a misstatement in the prospectus. Then we will punish you. In criminal liability, whether you have suffered a loss, whether you subscribed or whether you purchased, all that doesn't even matter. In criminal liability, straight away the government, the state directly takes action against the persons who authorized the issue of prospectus. The state directly takes action against them if there is mens rea. Mens rea means what? Mens rea means the misstatement did not happen by mistake. The misstatement happened purposely. That is when criminal liability comes into the picture. But civil liability, mens rea, no mens rea, doesn't even matter. Civil liability, what is required? Loss. Loss must be suffered. Loss must be suffered by subscribing to the company security. Loss must be suffered. For that loss, these 6 people liable. One last time. Who are the 6 people, everybody? One last time. The directors, then every person who authorized himself to be named in the prospectus as director, promoter, persons who authorize the issue of prospectus, expert, and company. 6 people are liable. Understanding, everybody? Name of the case law also tell me one last time. Peak versus Gurney. Peak versus Gurney. 100% clarity, everybody? Yes. So can I close this discussion regarding question number 23 here? Can I take you to question number 24? Yes. Question number 24 is one more question from the prospectus chapter only, but this question is relating to private placement. Okay, what happens in private placement? In private placement, company is not making an offer to the whole world. Company is picking and choosing people, and company is making an offer only to those specified chosen people. How does a company make an offer to them? What is the document which the company sends them? Company sends them this document called POCA. What does POCA stand for? Private placement offer cum application. Once again, what does POCA stand for? POCA stands for private placement offer cum application. POCA stands for private placement offer cum application. So this is a document which the company sends to all those selected group of people. But tell me, in a year, company can send this offer to how many people? Act says 50, but the rules say 200. So 50, 200, 50, 200, which one will I choose? I will choose 200 because the law says 50 or such other number as may be prescribed, which means the law itself is saying that anywhere else, if any other number is given, you follow that other number. So we will follow this other number. 200 is an actual number. This 200 number is for each kind of security separately. So equity shares, separate private placement, 200. Preference shares, separate private placement we can make for 200 people. Debentures, separate private placement we can make for 200 people. So each kind of security, 200, 200, 200 limit we have. And this 200, does it have to be like one time 200? Or can it be throughout the year, like 50 in January, another 50 in February? Can it be in bits and pieces? Yes, it can be in bits and pieces. This limit is for a year. This limit is for a financial year. In the whole financial year put together, maximum limit of 200 people per security. But this limit itself is not applicable to NBFC and Housing Finance Company, which means these two companies can make a private placement offer to any number of people. Then when you count 200 people, whom will you not count? You will not count qualified institutional buyers. You will not count employees. You will not count qualified institutional buyers. You will not count employees. What if we make a private placement to more than 200 people? What will happen? In that case, even though it is a private placement, I will start treating it as if it is public offer. Fine, treat. What big thing? Big thing. Once I start treating it as a public offer, what will start applying? SEBI rules and regulations will start applying, which are dreadful, which will make the company very, very uncomfortable, because SEBI rules and regulations are always very, very strict when compared to Companies Act rules and regulations. Understood, guys? So this is the concept involved in this question. This whole question is targeting the 200 point. Okay. So Act says 50 people. Rule says 200 people. We will follow 200. 200 limit is for the entire year. 200 limit is per security. Equity share separately, preference share separately, debenture separately. Limit itself is not applicable to qualified institutional buyers and to employees. And this, limit itself is not applicable to NBFC and Housing Finance Company. When you're counting 200 people, you will not count qualified institutional buyers and employees. If the company makes a private placement to more than 200 people, even though it is a private placement, we will treat it as if it is public offer. Keep this concept in mind. Look at this question. CDS Limited. Guys, public company. Can public company also make private placement? Yeah. Any company can make private placement. Public, private doesn't matter. Managing director arranged to obtain a brief note from some source explaining the salient features of issue of private placement that the board of directors shall keep in mind while approving the proposal on this subject. Brief note includes, inter alia, information or suggestions on the following points. A private placement shall be made only to a select group of identified persons not exceeding 200 in a financial year. Till here correct? Yes. The aforesaid ceiling of identified person shall not apply to offer made to qualified institutional buyers. Till here correct? Yes. But it is applicable to employees of the company. Is that right? No, this is a problem, because just like how we exclude qualified institutional buyers, we're also supposed to exclude employees. Then the question says, the offer on private placement basis shall be made only once in a financial year, not exceeding 200. Is it like that? No, you can make the private placement offer any number of times in the year. Just that the total offers per security in a year should not be for more than 200 people. But there is no rule that you should make only once in a year and all. There is no rule like that. I told you, right? In Jan, you can make a few offers. Feb, you can make a few offers. You are allowed to make private placement offer in bits and pieces. It is not necessary that you can do only once. Only rule is that in the entire year, per security, number of people to whom you made the offer per security should not exceed 200. That is aggregate in the entire year per security. But there is nothing like only once you can do it. That is wrong. Company solicits your remarks on the point referred above as to whether they are valid or not. So what will you say? First point, what is not valid? First point, they are saying employees have to be considered. No, employees also have to be excluded. Just like how we are excluding qualified institutional buyers, even employees we will exclude. Second wrong point, there is no rule that you can make private placement only once in a year. There is no rule like that. The only rule is that in that particular financial year, all the equity shares private placement offers should not exceed 200. All the debenture private placement offers should not exceed 200, and all the preference shares should not exceed 200. Right, guys, this is question number 24. This was a very important question. We've gone very, very in-depth in the 200 number discussion here. Okay, come on now. Let's go to question number 25. This question is from buyback, share capital chapter, buyback. Now, here in this question, there are time limits which are being discussed. See, I will, in buyback, I generally noticed that it is a time limits where the students generally get stuck. So I'll draw one diagram for you discussing all the time limits, and then you will not make a mistake on time limits at least after this. See, listen, for buyback, sometimes we need a special resolution. Sometimes just a board resolution is enough. Like if I'm going to spend only up to 10% of paid up share capital plus free reserves plus securities premium, if I'm going to spend within 10%, I need only a board resolution. If I'm going to spend more than 10%, but maximum how much I can spend anyways? Maximum anyways I can spend only 25%. So more than 10% up to 25%, I need a special resolution. But if I'm spending within 10%, I need just a board resolution. So whatever resolution I have passed, this resolution will have validity period of how long? Tell me. This resolution will have validity period of 12 months, right? Within 12 months, what should I do? Within 12 months, I must complete the buyback. Within 12 months, we must complete the buyback. Once we complete the buyback, within 30 days, we must go to the ROC and we must file the buyback return. Once we complete the buyback from this date, within 7 days, what should we do? Within 7 days, a company should extinguish the shares, which means the company should destroy the shares, bring an end to the shares within 7 days. Once we complete the buyback, tell me how much do I have to wait to do a buyback again? What is the gap between two buybacks? Between two buybacks, we need to wait for 1 year, right? And once we complete a buyback, next day itself, can we issue more securities? When can we issue more securities and raise money? When can we issue more securities and raise money? Only after 6 months. So what is the 6 months period called? The 6 months period is called as cooling period. So if you want to issue more securities of the same kind, see, if you want to issue other securities, like I bought back equity shares, and if I want to issue debentures, there is no restriction on me. There is a restriction. I bought back equity shares and I want to issue more equity shares. That is where I have to wait for 6 months. So if I want to issue securities of the same kind, I have to wait for 6 months. 6 months cooling period I have. But tell me, in the 6 months, can we issue bonus shares? Yes, in the 6 months, I can issue bonus shares. In the 6 months, tell me, can we convert existing convertible preference shares? Can we convert into equity? Yes. In the 6 months, can we convert existing convertible debentures? Can we convert into equity? Yes. In the 6 months, what you can't do, you can't issue more securities of the same kind. That alone you can't do. Is this clear? So are you noticing it's very easy to remember the time limits if you're going to follow this diagram, from the special resolution or the board resolution that will have validity period of 12 months. Within 12 months, you should complete the buyback. From the date on which you complete the buyback, within 30 days, you have to file the buyback return. Within 7 days, you have to extinguish the shares. If you want to buy back again, you have to wait for 1 year. And if you want to issue more securities of the same kind, you have to wait for 6 months. 6 months is called the cooling period. Now, with this in your mind, look at this question. Here, question number 25. The question says, the offer of buyback of its own shares by a company shall not be made within a period of 6 months from the date of closure of the preceding offer of buyback. Is this right? 6 months time limit is for what? I just discussed with you. 6 months time limit is for when the company wants to issue more securities of the same kind. Cooling period is 6 months. But between two buybacks, what's the time limit? 1 year. The question is saying offer of buyback of its own shares shall not be made within 6 months from closure of preceding offer. Wrong. It should be 1 year. Time gap between two buybacks has to be minimum 1 year. And cooling period to make further issue of same kind of shares, including allotment of further shares, period of 1 year. This is also wrong. This should be what? This should be 6 months. So they have given ulta. The cooling period should be 6 months and the gap between two buybacks should be 1 year. So is the statement valid? They're asking us about the validity of the statement. No, the statement is not valid. The reason why I've picked this question is, through this question now, we have had a solid revision of the most difficult part of buyback, which is the time limits. And just one small pro tip over here, please learn declaration of solvency properly under buyback and go. Declaration of solvency, important concept under buyback. Please learn that concept properly and go. In buyback, learn declaration of solvency. These time limits I've anyways covered for you, and also learn that one more thing, that the three limits. How many shares you can buy back maximum? Buyback maximum 25% of the shares. How much money can you spend on buyback maximum? 25% of paid up share capital plus free reserves plus securities premium. And after buyback, debt equity ratio has to be it should not be more than 2:1. So that part also. So the time limits under buyback, the declaration of solvency, and those three conditions of buyback, these three very, very important things under buyback, you make sure you learn them properly and then go. Okay, let me take you forward. Shall we proceed? Shall we go to the 26th question now? Listen. Question number 26. This is from the deposits chapter. We haven't done even one question from the deposits chapter, and this is the question which I have chosen from this chapter. The deposits chapter, please make sure you do the exclusions properly. You have the big list of exclusions. No, what and all is not considered as deposit. Mostly it has been seen that from the deposits chapter, there is at least one question from there. To do the deposits chapter, the exclusions properly. This question is from one of the exclusions. Now, which exclusion? Listen, if we have received from the promoters or from the promoters' relatives any unsecured loan, if we have received, because of a stipulation put by lending financial institution or bank, then the unsecured loan will not be considered as, the promoter's unsecured loan, this loan will not be considered as deposit. But if the loan is repaid, still if we keep the promoter's unsecured loan, then it will be considered as a deposit. I'll help you understand this in a little simpler manner. Listen, let us say there was one company, Anushree Spinning Mills Limited. Basically, this question involved over here, this itself I'm putting straight away in the form of the example. There was this company, Anushree Spinning Mills Limited. SIDCL was a lender of money. They were a lending financial institution. They were lending a loan to the company. but they lent a loan under a stipulation. Stipulation means what, guys? Stipulation means they put a condition. What condition they put? They said, we'll give you a loan under a condition that your promoters or your promoters' relatives or both, they should give you an unsecured loan. So we will give you a loan under a condition that your promoters or relatives should give unsecured loan. So any unsecured loan that we have received from a promoters, their relatives or both, because of a stipulation or a condition put by the lender, put by the bank or by a lending financial institution, this unsecured loan will not be considered as deposit. It is excluded from deposit. But guys, tell me, once the company has repaid SIDCL's loan, tell me, will the stipulation still exist? If the loan itself doesn't exist, the stipulation will not exist, which means this unsecured loan is not required anymore. So what should the company do? The company should return the unsecured loan. But if the company doesn't return the unsecured loan, this unsecured loan will now be considered as deposit. Understood, everybody? So till SIDCL's loan is existing, then this will be not a deposit. Once we have repaid SIDCL's loan, stipulation is not existing anymore. So unsecured loan you don't need anymore. So come on, repay the unsecured loan. But if you don't repay, if you continue to keep the loan, now it will be considered as deposit. Keep this in your mind and have a look at this question along with me. The question says, promoters of Anushree Spinning Mills Limited contributed in the shape of unsecured loan to the company in fulfillment of margin money requirements stipulated by SIDCL. So SIDCL put a stipulation. Under that, the promoters of the company gave an unsecured loan. In the light of the provisions of the Companies Act, whether the unsecured loan will be considered as a deposit, guys? No, it will not be considered as a deposit. What will be your answer in case entire loan from SIDCL is repaid? Tell me, what if the SIDCL's loan is repaid now? Once SIDCL's loan is repaid, will the stipulation still exist? Stipulation is not existing anymore. So we should not keep the unsecured loan. We should return the unsecured loan. But if we still keep the unsecured loan, it will now be considered as deposit. Simple. Understood? Yes, this was question number 26 for you. Come on, guys. Let's proceed. Let's go ahead. Let's go to question number 27. This is a question from the charges chapter. Okay, this question is very, very important from your examination point of view. I'm not saying that the same question as it is will come in your examination, but the concepts involved over here might appear in your examination in various forms. Okay, so listen very carefully. I'm hoping that you're able to, with this entire discussion, I think a very good revision is happening. Yes, we did end up spending quite some time, but then solid revision of, we were supposed to do just 30 questions, but I think we ended up revising quite a lot through these 30 questions. It feels like every chapter, good amount of concepts we have ended up touching upon. Anyways, come to question number 27. Let us have a look at the question. Rose Private Limited on 3rd April 2019 obtained 30 lakhs working capital loan by offering stock and accounts receivable as security and 5 lakhs ad hoc overdraft on the personal guarantee of a director of Rose Private Limited from a financial institution. Listen, there is one company, Rose Limited or Rose Private Limited. They obtained 30 lakhs working capital loan. To get this loan, they gave their stock and their accounts receivable, they gave this as security. Okay, and they also got 5 lakh ad hoc overdraft. They also got 5 lakhs ad hoc overdraft on the personal guarantee of director against director's guarantee from a financial institution. So both they got from one financial institution. Is it required to create charge for working capital loan and ad hoc overdraft? Tell me. For the working capital loan, we have given stock and receivables as security. So for this working capital loan, is there any charge that we have to create and register and all? Yes, we have given stock and receivable. We have given current assets as security. Guys, we have given current assets as security. So which means, what kind of a charge is it? Don't you think this will become a floating charge? And even floating charge has to be registered, isn't it? Yes, even floating charge has to be registered. So therefore, yes, it is a floating charge, and even floating charge, just like any other charge, has to be registered. Tell me, in your whole charges chapter, did you learn any separate provision for floating charge, any separate provision for fixed charge? No. Whatever rules and regulations you have learned for registration of charge, all those rules and regulations will apply, whether it is floating charge, whether it is fixed charge, whether it is tangible asset, whether it is intangible asset, whether the asset is in India, whether the asset is outside India, it doesn't even matter. So it will apply to all. So even this floating charge, yes, it has to be registered. But tell me, this ad hoc overdraft, tell me, against this ad hoc overdraft, did the company give any asset as security? No. Against this ad hoc overdraft, only one director gave guarantee. Is there any security that we have given against the ad hoc overdraft? No. So here, do we have to register or create any charge? Not required. Understood, everybody? Yes, for the ad hoc overdraft, I don't have to create any charge at all. Come on, tell me, did you understand this point? Yes, for the working capital loan, yes, I have to register the charge because it is a floating charge, and even floating charges have to be registered. But ad hoc overdraft, against this, I don't have to register any charge because the company did not give any asset as security. This was given only against the director's guarantee. This and all does not have to be registered. But listen, they're also asking us the main reason why I'm discussing this question, the whole process, the time limits, guys. See, I have given over here everything about floating charge. When does the floating charge crystallize? The floating charge crystallizes when the terms and conditions of the charge are violated, when the company winds up, when the creditor enforces security. All this is not directly related to the question, but just I wanted to put down all these concepts in your material for you so that you can revise them properly before the examination. But come to this part now. This is my major discussion with you right now. See, every company which is creating a charge, it has to register the particulars of charge along with the instrument creating the charge in form number CHG1 within 30 days of creation. So within 30 days, the company has to register the charge. The company will file form CHG1 with the ROC. Company will send three things to the ROC. Company will send the particulars of the charge in form number CHG1. The company will send the instrument creating the charge, and company will send fees. Three things company has to send to the ROC. Come on, guys, tell me, within how many days? Within 30 days, the company will send it. Now listen, what if the company is not able to send within 30 days? No problem, company. You can send within 60 days from creation, which means how much extra time I have given the company? 30 days extra time I have given the company. But I gave you extra 30 days time, so you have to pay additional fees. You have to pay additional fees. Even in the 60 days, company did not register even in the 60 days. No problem, company. Take extra 60 days, which means total how much time? Total 120 days time. You are not, see, actually you're supposed to register within 30. You did not register within 30. Fine. You registered within 60. You did not register within 60 also. Fine, you register within next 60. But if you are registering in this next 60, you have to pay ad valorem fees. Very, very important point. If you are registering within 30 days, you will pay fees. If you are registering within 60 days, you will have to pay additional fees. If you are registering within next 60 days, you will have to pay ad valorem fees. But listen, if you don't register within 30 days, if you're taking extra 30 days, if you're taking extra 60 days, then what is the process? If you want this extra time, you have to file an application with the ROC. You have to make a declaration with the ROC that don't worry, ROC, yes, I am registering the charge late, but still don't worry, the creditor will not suffer because of my late registration. The creditor will not be affected because of my late registration. And I also have to give sufficient cost to the ROC that why wasn't I able to register within 30 days? Why am I asking extra time? I have to give a sufficient cost to the ROC. Once ROC registers the charge, ROC will give me the certificate of registration of charge in form number CHG2, which will be a conclusive evidence that the charge has been registered. Understanding this is a whole process. So from the date of creation of the charge, within 30 days, I'm supposed to register the charge by sending three things to the ROC. Number one, the particulars of the charge in form number CHG1. Number two, the instrument creating the charge. And number three, fees within 30 days. If I'm unable to send within 30 days, I can send within 60 days from the date of creation, but there I'll have to pay additional fees. If I'm unable to send within 60 days also, I can send within the next 60 days, but next 60 days I'll have to pay ad valorem fees. Do you have to remember form numbers? Not all form numbers, but charges chapter at least, please learn the form numbers. Some important form numbers here and there you should be aware of. Like for example, in auditors chapter, fraud. When the auditor reports a fraud, the form number over there, ADT4, then you have form number AOC1, form number AOC4 and all in your accounts of companies chapter. CSR registration, you have CSR1, CSR2, those two form numbers. So some form numbers here and there are important, but I would suggest don't spend too much time and energy on form numbers. If you're able to remember them, great. But now 10-15 days before the examination, don't take the extra pressure of learning form numbers. If you're able to remember the important ones, great, nothing like it. But charges chapter, please put in a little extra effort and learn up the form numbers, because charges chapter, the reason is so many times it so happens that the charges chapter comes in your examination just in the MCQs. But big 5 marks or 7 marks, a case study based MCQ, they'll give off in the MCQ straight away. They will finish off the charges chapter. So because it is an MCQ, a highly probable question, form numbers, you be careful just in case they test the form number in the MCQs. So charges chapter, at least there are 6 or 7 form numbers only. Learn them up properly. Okay, now listen, coming to the next question, question number 28. Question number 28 is again a question from your meetings chapter. Okay, a very good question. Through this one question itself, multiple concepts are getting touched one after the other. Listen. Multiple concepts, guys. We will end up discussing about AGM. We will end up discussing about annual return. We will end up discussing a little bit about quorum also. Multiple concepts are getting touched upon. Let us look at the concepts first of all. See, quorum is nothing but the minimum number must be present. We've already seen what are the quorum numbers. How long will we wait for quorum? We will wait for quorum for half an hour. Within half an hour, if the quorum does not arrive, then what will we do with the meeting? Within half an hour, if the quorum does not arrive, we will adjourn the meeting to the same day, same time, same place in the next week, or some other date, time, place. Who will decide? The board of directors will decide. Now, for this adjourned meeting also, yes, we have to give a notice, but your adjourned meeting, 21 days notice not required, only 3 days notice is required. But if it is not possible to send this notice 3 days before the meeting, you can also simply advertise this notice in one English newspaper, one vernacular newspaper having wide circulation in the place where RO is situated. Even that will be enough. In this adjourned meeting also, if you don't have quorum, even in this adjourned meeting, if you don't have quorum, then how many of our members are present in the adjourned meeting? You assume that itself is quorum and you keep going on. However, if the meeting was called by requisitionists and in that meeting, if there is no quorum, then the meeting will not get adjourned. Instead, the meeting will get cancelled. Okay, then listen. So this was a quorum discussion. Quorum discussion, you've understood. Quorum, how long will you wait, guys? Quorum, you will wait for half an hour. Within half an hour, if the quorum does not come, then what will happen? Within half an hour, if you don't get the quorum, then the meeting will get adjourned to same day, same time, same place in the next week, or some other date, time, place which the board will decide. For that adjourned meeting also, you have to give a quorum, you have to give a notice. That notice has to be 3 days notice. But if it is not possible to give 3 days notice, at least please give an advertisement in one English newspaper, one vernacular newspaper having wide circulation in the place where RO is situated. In this adjourned meeting also, if there is no quorum, then no problem. How many of our members are there? You assume that itself is quorum and you continue the meeting. Now listen, can I say in every adjourned meeting you don't need quorum? Can I say? No. Only if the last meeting was adjourned because of lack of quorum, only then in the adjourned meeting I don't need quorum. How many of our members are present? That itself is quorum. I can continue with the meeting. But if the last meeting was adjourned because of some other reason, like because of lack of time or because of any other reason, if the last meeting was adjourned, then in the adjourned meeting also I need quorum. Okay, that was our point about quorum. Now listen, annual general meeting, every company has to have an annual general meeting. At least this annual general meeting will be once in a year. 1% company does not require annual general meeting. All other companies require annual general meeting. For any shareholders meeting, notice will go. if it is AGM, in the notice heading, it should be written that this is notice of AGM. Okay. When should we hold the AGM? 3 time limits we have. Out of the 3 time limits, we will pick which is the earliest. That will be the last day by which we have to hold the AGM. What are the 3 time limits? The gap between 2 AGMs can be maximum 15 months. From the end of the year, within 6 months, we have to hold the AGM. And in each calendar year, we must have at least 1 AGM. 3 conditions, 3 time limits. Out of the 3 time limits, you will pick whichever is the earliest. What are the 3 time limits? Number 1, the gap between 2 AGMs should be maximum 15 months. Number 2, from the end of the year, within 6 months, we have to hold the AGM. And number 3, there must be 1 AGM in each calendar year. If I'm not able to hold the AGM within this much time, I can go to the ROC. I request the ROC to please give me extension. ROC will give me maximum how much extension, guys? Maximum 3 months extension ROC will give me. Now listen, the first AGM has a different time limit altogether. For the first AGM, the time limit is from the end of the financial year within 9 months. Generally, it is end of the financial year plus how many months? Generally, it is end of the financial year plus 6 months. But here it is end of the financial year plus 9 months for the first AGM. Which means for the first AGM, I'm already giving you extra time. So therefore, for the first AGM, you cannot come to the ROC and again ask extra time. You are already given 3 months extra time for first AGM. This was our AGM discussion. So every company should have AGM. AGM notice heading itself, it should be mentioned. This is notice of AGM. When should the AGM be held? 3 time limits. Earliest of the 3 time limits. Gap between 2 AGMs, 15 months maximum. In each calendar year, 1 AGM we should have. From the end of the year, within 6 months. So whichever is the earliest of these 3 time limits, within that date, you have to hold the AGM. If you're unable to hold within that date, go to the ROC, ask extension. ROC will give you maximum 3 months extension. First AGM, you have to hold within 9 months. You have to hold within 9 months from the end of the financial year. I'm already giving you extra time over here for the first AGM. So I will not give you any extra time beyond that. Then listen, so first concept we discussed, quorum. Second concept we discussed now, AGM. Third concept we're discussing now, annual return. See, from the end of the from the date of AGM, whatever is the date of AGM, from that day, within 60 days, we have to file the annual return with the ROC. From the date of AGM, within 30 days, we have to file financial statements with the ROC. These 2 time limits, very often students get confused. Please do not get confused. Please remember this. From the date of AGM, within 60 days, you have to file annual return. Within 30 days, you have to file financial statements. But what if AGM itself is not held? Then you will have to see what is the last day by which AGM should have been held. From that day within 60 days, from that day within 30 days, you should do the filing. What if you don't do this filing on time? What if you don't file the annual return properly? Company will be punished with 10,000 rupees. Officer in default will also be punished with 10,000 rupees. Company and officer in default both will be punished with 100 rupees per day of delay also. But maximum punishment for the company is 2 lakhs. Maximum punishment for the officer in default is 50,000. And this form number is again important. What is the form number of annual return? Generally, the form number is MGT7. But if it's a 1% company or if it is a small company, we have an abridged annual return. Basically, a summarized version of the annual return, which is MGT7A. So generally, it is going to be form number MGT7. But however, if it is annual return of 1% company or annual return of small company, their abridged version, summarized version, you have summarized version in the form of MGT7A. Okay, so these were all our concepts involved in this question. Okay, I went a little overboard with the conceptual discussion in this question. I just wanted to discuss all of these points with you. Not all of them are actually involved in the question, just that they're all important points, okay? Because I know that this one file is going to be so useful for you all the day before the examination. All these concepts over here. See, that 1.5 days before the examination, no, you make sure that at least all the concepts which are there in this file, okay, all the concept part, all the points which I have put under the concept part, at least that you make sure that you read and go. Like for sure, okay, for sure this has to be read and gone. Okay, now listen, coming back. Look at this question now. Nutty Buddy Limited is manufacturing premium quality milk-based ice cream in 2 flavors, chocolate, butterscotch. Okay. Company called its AGM to lay down financial statements. But due to want of quorum, meeting was cancelled. Here itself tell me, is it right? If quorum is not there, should we cancel the meeting? No, we should only adjourn. Which meeting can be cancelled? Only the meeting which was called by requisitionists, only that we can cancel. Right, guys? Other meetings now we should not cancel, we should only adjourn. So here itself one wrong has happened. Also, directors of the company did not file annual return with the ROC. Is that right? No. Even though we did not hold the AGM, from the last day on which the AGM should have been held, within how many days you should have filed the annual return? Within 60 days, you should have filed the annual return, but you did not file. So who will be punished? Company also will be punished. Officers in default also will be punished. How much will they be punished? 10,000 both will be punished, and also both will be punished. 100 rupees per day will be punished. But maximum penalty for company, how much? 2 lakhs. For officer in default, maximum 50,000. Okay, so these are all the concepts involved over here. So there is no quorum company. You should not cancel the meeting. You should adjourn the meeting. And directors, and even if you don't have the AGM, even if the AGM is not held within 60 days from the last day on which the AGM should have been held, you should file the annual return. Annual return form number? Just now we discussed form number MGT7. If it is 1% company or small company, then you have abridged annual return. What's the form number there? There it is form number MGT7E. Okay, so this was question number 28 for you. Now coming to question number 29, our second last question. This is from the dividends chapter. Remember I was telling you one small computation question from dividends chapter I have for you. This is that one. This question is also there in your study material. Important question. Listen to me. If the company, listen, how much dividend can the company distribute maximum? There is no limit. Generally, there is no limit. But in the current year profits are absent, or if the current year profits are insufficient, okay, then the company will take money from where to pay dividend? Company will take money out of accumulated profits to pay dividend. When the company touches the accumulated profits, that is where the company will have a limit. Understanding. So if the company is taking money out of current year profits, no limit. Company pay how much ever dividend you want to pay. Companies in this last 1 year, they've paid 300%, 400% dividend and all, pay, no problem. But companies saying current year profits are insufficient, current year profits are absent. So can I please take money out of accumulated profits? Okay, fine, take. But if you're taking money out of accumulated profits, there will be a limit. Okay, now how to calculate the limit? Listen. There are totally 4 conditions. Condition number 1, before you take money out of accumulated profits, you must first set off earlier year's depreciation and earlier year's losses. Only then you can take money out of accumulated profits. Number 2, maximum you can pay dividend only last 3 years average. Maximum rate can be last 3 years average. But like let us say in one of the years you did not even declare the dividend. So should it be 5 plus 8 plus 0 by 3 or should it be 5 plus 8 by 2? One of the years you did not even declare dividend. Maximum rate will be last 3 years average. One of the years you did not even declare dividend. So will it be 5 plus 8 plus 0 by 3 or will it be 5 plus 8 by 2? It will be 5 plus 8 by plus 0 by 3. So the year in which you did not pay dividend, that year you will consider as 0. Okay, but what if all the 3 years you did not even pay dividend? Then that condition itself will not apply. Okay, so the second condition is that last 3 years average dividend rate, that will be the maximum rate which you can pay. But all the 3 years, all the 3 years, if you did not even pay any dividend, then in that case, this condition itself will not apply. Maximum, how much can you take out of reserves? 1/10 of paid up share capital plus free reserves. But from this, you have to subtract current year losses. So 1/10 of paid up share capital plus free reserves minus current year losses. This is the maximum amount which you can take out of reserves. Once you take the money out of reserves, how much money should still be there in the reserves? Still 15% of paid up share capital should still be there in the reserves. Okay, so we have totally 4 points over here. Now look at this question. There's this company Capricorn Industries Limited. It has a paid up capital of 200 lakhs, accumulated reserves of 240 lakhs. Current year losses 30 lakhs. Dividend was declared 9%, 10%, 12% in the last 3 years. They're asking us what is the maximum rate that we can declare. See, listen, we are paying dividend and current year we have a loss. So obviously we are going to pay dividend out of what? because we have loss in the current year we have a loss, so very obviously we are going to pay dividend out of accumulated profits. So as soon as you touch accumulated profits, conditions will apply. First of all, I will assume that out of accumulated profits we have already set off earlier years depreciation. I will assume that you have already set off earlier years losses. The question doesn't say anything. I'll assume you have already set off earlier years depreciation, you have already set off earlier years losses. I will assume. Condition number 2, maximum rate can be what? Last 3 years average. Last 3 years average is what? 9% plus 10% plus 12% divided by 3. This is going to be how much? 9 plus 10 plus 12 by 3. This is going to be 10.33%. This is a maximum rate of dividend. But what if it was 9, 10 and 0? Then what would you divide it by? You would divide it by 2 or would you divide it by 3? You would divide it by 3. What if it was 0, 0, 0? Then in that case, this condition itself would be not applicable. So 10.33%. Now 10.33% of what? 10.33% of capital. So 200 lakhs into 10.33%, this is going to be how much? This is going to be 20.67 lakhs. So this is how much money you can pay on the basis of the second condition. What is the third condition? Maximum how much amount you can take from your reserves? 1/10. 1/10 of what? Paid up share capital. 1/10 of paid up share capital plus reserves minus current year losses. What are current year losses? 30 lakhs. So how much would this be? This is going to be 14 lakhs, guys. So 20.67 lakhs or 14 lakhs. Here itself, which number will you take? Obviously, whichever is lesser. So which is going to be 14 lakhs, right? So how much reserves are you having? 240 lakhs reserves you're having. From this 240 lakhs, if you take off this 14 lakhs, how much money are you still left with? You will still be left with 226 lakhs. You will still be left with. But how much minimum should you be left with? Minimum 15% of paid up share capital you should be left with. That is minimum 15% of 200 lakhs you should be left with, which is going to be how much? Which is going to be 30 lakhs. 30 lakhs minimum you should be left with. But how much are you left with? You are being left with 426 lakhs. So can I pay 14 lakhs dividend out of accumulated profits? Yes, I can. Understood? Yes. See, I'll repeat once again. How do you calculate this? First of all, the first condition you will always assume. You will always assume that we have already set off earlier years losses. We have already set off earlier years depreciation. This is one point which you will always assume. Okay, then coming to the second point, what's the maximum rate of dividend? Maximum rate is going to be last 3 years average. Last 3 years average. But in all the 3 years, if you did not even declare dividend, then this condition itself will not apply. So last 3 years average was 10.33%. So how did we get this number, guys? How did we get this number? We simply did 10.33% of capital. Obviously, dividend will be a percentage of capital. See, generally, dividend is a percentage of face value, or is it a percentage of paid up value? Generally, dividend is always supposed to be a percentage of face value. Okay, paid up value only if the AOA specifically mentions. Otherwise, dividend is supposed to be a percentage of face value. But in this question, they have not given us face value. They have given us only paid up capital. So we also don't have an option. So that is why we did 10.33% of the paid up capital. Then maximum how much amount we can take out of reserves? 1/10 of paid up share capital plus free reserves minus current year losses, right? That is 14 lakhs. Now 20.67 as per condition 2, 14 lakhs as per condition 3. So obviously we can take whichever is lower, which is 14 lakhs only. So out of my reserves of 240 lakhs, if I take 14 lakhs, I'm left with 226 lakhs. But how much minimum is required, guys? Only 15% of paid up share capital is required. Minimum should be there in the reserves. So 15% of paid up share capital, minimum 30 lakhs should be there in the reserve. But forget about 30 lakhs. We have 226 lakhs in the reserve. So if I take 14 lakhs, all my conditions will get fulfilled. So how much money you can take? 14 lakhs is a maximum money which you can take out of reserves. If you're going to take 14 lakhs out of reserves, what rate of dividend is it? 14 lakhs divided by 200 lakhs capital. 14 lakhs if you're going to pay, it's going to be what rate dividend? It's going to be 7% dividend. Okay, that was question number 29. All right, now coming to the next question, the last final question. Question number 30 from the auditors chapter. Okay, one last question from the auditors chapter. Board of directors, wait, before we come to the question, let us discuss the concept. If you talk about the first auditor in a non-government company, other than government company, non-government company, first auditor is supposed to be appointed by the board of directors within 30 days from the date of incorporation. See, the board delegates a lot of matters to committee, but first auditor appointment and all cannot be delegated to a committee, not allowed. So board is supposed to appoint within 30 days from company's incorporation. If the board doesn't appoint within 30 days, then within 90 days from the date of incorporation, the shareholders itself will have to appoint. So first of all, first chance we will give to the board of directors. The board of directors are supposed to appoint within 30 days from incorporation. If the board does not appoint within 30 days from incorporation, then in that case, within 90 days from the date of incorporation, the members will have to appoint. This first auditor, he will hold office till when? He will hold office till the conclusion of the first AGM. The word conclusion is important. Don't say till the first AGM, say till the conclusion of the first AGM. Now, if you look at the term of auditors, see in these 4 specified companies, I can appoint an individual only for one term of 5 years. I can appoint audit firm only for 2 terms of 5 years. I am saying of 5 years. I am not saying up to 5 years, which means tell me, can one term be 4 years? No, it is one term of 5 years. So each term has to be equal to 5 years. It can't be less than 5 years. After this one term, after these 2 terms, we have to give a cooling period of 5 years. In this cooling period of 5 years, we can't appoint the same auditor again. We can't appoint partner of the firm. We can't appoint any other firm which has common partners. We can't appoint any other firm which comes under the same network of firms, not allowed. But this concept is not applicable to every company. It is applicable only to listed companies, unlisted companies with paid up share capital at least 10 crores, private companies with paid up share capital at least 50 crores, and companies with borrowings from financial institutions, bank and public deposit, not all deposit, not private deposit, only public deposit, not deposits from members, only public deposits, at least 50 crores. It's applicable only to these companies. Understanding? So if you want to appoint auditors, first auditor, board of directors will appoint within 30 days. If board doesn't appoint, within 90 days from incorporation, members will appoint. The first auditor will hold office till the conclusion of the first AGM. And what is a term of auditors? I can appoint an individual for one term of 5 years. I can appoint a firm for maximum 2 terms of 5 years each, which means total 10 years. Term has to be of 5 years. It can't be less than 5 years. It can't be more than 5 years. After a term, after this 1 term, 2 term is over, we have to give a cooling period of 5 years. In this cooling period, we can't appoint the same auditor. Partner of the firm, we can't appoint. Any other firm with common partner, we can't appoint. Any other firm in the same network of firms, we can't appoint. But this concept is not applicable to every company. This concept is applicable only to listed companies, then public companies with paid up share capital at least 10 crores, private companies with paid up share capital at least 50 crores, and all companies with borrowings at least 50 crores. What about other companies? In other companies, this concept is not applicable. Other companies, no cooling period. They can keep on reappointing after at a time, even they will appoint for 5 years, one term of 5 years. But after that, they can keep on reappointing, no cooling period concept at all. Okay, guys, now we'll have a look at this question. With all this understanding, very easily you will be able to handle this question. Look at it. The question says, Board of Directors of Moonlight Limited, a listed company, appointed Mr. Tell, Chartered Accountant, as a first auditor within 30 days of registration. Is it right, guys? Yes, it's a non-government company. Board of Directors have appointed within 30 days of incorporation. Correct only. He is going to hold office till the conclusion of the first AGM. Even this is correct only. At the first AGM, Mr. Tell was reappointed. Guys, it is a listed company. Listed company means it is one of the specified companies. So here cooling period of concept is applicable. So we had an individual, Mr. Tell, who was a first auditor. After his term got over, we reappointed him from the conclusion of first AGM till the conclusion of sixth AGM, which means we appointed him for a term of 5 years. But we reappointed him. It's a listed company, specified company. Examine the validity. Tell me, appointment of Mr. Tell by board of directors. Basically, the first auditor appointment, was that okay? Yes, the first auditor appointment, it was okay because the board appointed him within 30 days from incorporation and he held office till the conclusion of the first AGM. Perfect only. Then, reappointment of Mr. Tell at the first AGM in the above situation. See, listen, it's a specified company, it's a listed company. In a listed company, can we reappoint individual? No, no, right. Individual we can appoint only for one term of 5 years. After that cooling period of 5 years. But always remember, first auditor concept, first auditor appointment is not even considered. So first, Mr. Tell was appointed as first auditor. Then he was appointed for 5 years. So when you're considering the cooling period concept and all, don't even consider the first auditor concept. Understanding? So reappointment of Mr. Tell, yes, Mr. Tell was being reappointed. Yes, in listed companies, individual can't get reappointed because individual one term of 5 years, then cooling period. Only then you can bring them back. Yes, in listed companies are specified companies, and in these specified companies, we can't reappoint individuals. But here, we are reappointing after first auditor term only, no? So first auditor term, we don't consider. Yes, after first auditor term, we can appoint him for 5 years, even this is allowed. But look at this. In case Mr. Bell Chartered Accountant was appointed at the first AGM to hold office from the conclusion of first AGM till fifth AGM, which means for how many years? Only for 4 years. Is this allowed? This is not allowed, but because it can't be less than 5 years. It has to be equal to 5 years. It can't be 4 years. It has to be equal to 5 years. For 4 years, we can't appoint. Understanding? Getting it, guys? So that's it about question number 30. Remember that this concept is not applicable to every company. It's applicable only to listed companies, unlisted public companies with paid up share capital at least 10 crores, private companies with paid up share capital at least 50 crores, and companies with borrowings at least 50 crores. And also, please do not forget that this whole concept that we've discussed over here is not applicable to the first auditor appointment. We will ignore the first auditor appointment. Over and above the first auditor appointment only, we will apply this concept. All right, guys. Okay, so can we close this discussion over here? We're finally done with these 30 questions. All right. Now, my